That beat on the back largely of cost cutting, still seeing a relatively soft picture in the Chinese market. We look at Carlsberg then in terms of the response there. UBS is called higher the last time we checked by about 4%. That should give a lift again to the finance and banking sector. Guy?
Yeah, 2 to 4% seems to be the trade this morning. We'll get that print in just a moment. But it is time in Europe for the opening trade on CPI day in the United States. Bunch of corporate news that we need to factor into our thinking. So here are the numbers. Let's talk about the data. Let's see what we're seeing in terms of the opening trade here in Europe this morning. FTSE 100 opening fairly flat this morning. So you've also got the mechanical factor that the pound is down this morning post CPI. Now that normally gives the equity market a little bit of a lift because of the translation effect off that, because of so many international companies occupying the FTSE 100. So we'll see what effect that has as well, and whether we get some relative outperformance from the FTSE 100 on that weaker pound. So up by around 0.5% on the FTSE 100 already. The 600's out of the gate up a similar amount, to be honest. We're up by 0.4%. The CAC actually is outperforming this morning. We're up by 0.8% there. We'll wait for the DAX to open. We'll see what the SMI is doing. Italy is up by 0.5%, as is the Spanish market. Tom, there's some significant single stocks, though, that we need to be watching out for this morning. Let's get into the deeper dive on what we're seeing within these markets.
UBS currently up 3%, 2.6%. You talked about that range. We're basically bang in the middle of that in terms of what the guidance was in terms of the futures. You're currently seeing gains for UBS, 2.8% in terms of the upside in the first few seconds on the back of that sizable beat. And again, the details suggesting that UBS, Sergio Demotti, well on track in terms of absorbing the Credit Suisse business, and the wealth management part of that corporation doing very well in terms of the flows, 27 billion, and the top line beat, significant beat, double the estimates, net income coming in the second quarter of 1.1 billion. So a boost to UBS on the back of that. We're looking at the Hapag-Lloyd, I should say, in terms of the shipper, currently down 1.2%. You talked about the FTSE 100, interesting in terms of the softness of the pound, potentially offsetting some of the downside that's coming through in terms of basic resources, because that space, iron ore, taking a big hit in the session. Further concerns, further warnings about the demand picture out of China, and basic resources as a sector, the loss leader right now, down 0.7%. Every other sector posting some upside there. Consumers up 0.8%. Autos also getting a lift, Guy, up 0.7% so far in the session.
So Glencore's softer this morning, but the biggest point to drag on the stock 600 this morning is Rio Tinto. So as Tom makes the point, you can see it there quite clearly. You are seeing that sector under a little bit of pressure this morning. What I think is interesting as well is that Novo Nordisk is once again adding some softness, some weight to the downside. Once again, it is a little softer this morning. We're down by 0.5%. It's interesting. Is this in light of what we're seeing with Lilly? There's some really big events coming up in September, I am told, in terms of the obesity space, oncology as well, but obesity absolutely front and center. So it'll be interesting to see how people position out of August into September. But UBS currently up by 2.15%. We've also got some news coming out of Norway. Let me just bring you the details of what we're seeing there. The Norwegian Sovereign Wealth Fund returned 8.6% in the first half of the year. That's interesting. 8.6%. That's a decent performance. It's
a decent performance given what we've seen year to date. 138 billion US dollars in the first half. We've talked about some of the details around their repositioning. We're going to be speaking to the CEO. Repositioning, including, by the way, cutting stakes in the likes of Meta. They still have a sizable position in Nvidia. That company reports at the end of this month. And they've added, interestingly, to some of their positions in the oil and energy space. Again, we're going to be speaking to the Norges Bank Investment Management CEO, Nikolai Tangen. Always really fascinating, that conversation. 11:30 a.m. UK time. The Sovereign Wealth Fund of Norway returning 8.6% in the first half.
They basically have to own everything, though. outside of Norway. They can't, there's kind of restrictions on what they can do, but they basically have to own everything. But it's interesting to see what they're doing in terms of the tech space performance, given what we're seeing from the likes of Warren Buffett over at Berkshire Hathaway, who has significantly lightened up on some of the big tech names. Apple, obviously, absolutely front and center there. It's interesting to see that they're kind of sticking with some of those trades.
Yeah, they're holding, for example, around as we say, NVIDIA. Difference in terms of Apple, the upgrade in terms of the cycle around iPhones expected, that's what they're flagging in the second half of this year. Warren Buffett has taken that cut. So the Sovereign Wealth Fund, I mean, particularly given the focus, of course, as well on its energy credentials, or a lot of that funding, of course, most of it coming from, of course, the energy wealth of Norway, but the fact that they're also adding positions to some of those big providers and producers of oil and gas, when we know politically as well, that's a bit of a tension and sore spot, at least in some parts of the politics of Norway. Mark, Guy, I think we're going to be just name-checking you there. Mark Cudmore on the brain from our MLive team. We're also going to be listening into Amy Wu from RBC Capital Markets. I think we've been hearing in terms of some of the market volatility. So look, the volatility has plummeted, though, in the last 24 hours.
So volatility has come down. I guess, and Amy Wu Silverman's definitely somebody you want to listen to. I think her point really is that yes, we've been in for a bumpy ride, and yes, we may have stabilised a little bit, but have we forgotten that volatility? Take a listen to what she had to say.
Frankly, some people are doubling down on a lot of those short volatility trades that we've seen. That's created a lot of suppression. But look, I kind of liken this to being on an airplane that's been incredibly turbulent. Yes, we've kind of found the same altitude, but have we forgotten the turbulence? I don't think so.
Amy Wu Silverman joining us from RBC Capital Markets on what is happening in the options market. Yes, things have stabilized a little bit, but have we forgotten the volatility of last week? No, I don't think so. Seems to be the message coming through from her. Joining us now to carry on the conversation, Sharon Bell, Senior European Equity Strategist at Goldman Sachs. Sharon, have you forgotten the volatility? Is that an event that we can put in the rearview mirror, or do you think there's more still to come?
I think that the markets don't forget those things so quickly. We had gone through an incredibly low volatility environment with incredibly strong returns in the first half of this year. So I'm not surprised that the market is a little bit more queasy, let's say, in the summer period, where you've had some more concerning data on the sort of potential for a slowdown in the US. We don't worry about a recession, but clearly the market is perfectly priced at the moment still. So, no, I don't think it'll be completely forgotten.
In terms of what happens next, are the highs in for the year? Do you think there's more equity gains still to come? How choppy do you think it's going to be?
Yeah, look, I think that if we get returns from here, it's going to be relatively low because you've had very good returns since the beginning of this year up until that correction earlier on in the summer. And look, I think that markets have got to very elevated valuations, particularly tech stocks. You talked about some investors sort of divesting a little bit of these tech names, which have got to, not bubble levels, I would argue, but pretty elevated valuations. And the overall US market got to a PE of 22. It's come down a little bit from there, but still quite high versus the last 20 years of history. So still a bit vulnerable, we would argue.
So Sharon, good morning. What do you do with mega cap tech then? Do you hold your position, or do you fund other moves out of that space?
Well, we've been arguing that you want to diversify. So not that you want to reduce your tech allocation to zero or anything like that. We think that AI is going to lead to great productivity gains. We think that these companies are not in a bubble valuation. We think some of them will do extremely well. But we don't want everything in tech, and you certainly don't want everything either in the US. It's a highly concentrated market, very expensive by historical standards. So we would argue to diversify, not necessarily to be super underweight tech, but just equally not have a very large overweight position in something which is vulnerable every now and again to sell-offs. Having said all that, it's an area of fantastic growth. It's an area where companies are investing heavily. It's an area which will probably give you pretty good cash flows. You've started to see some of these companies paying dividends as well. So I'm not super against tech, but I do think diversifying is worthwhile. Geographically, sectorally as well, all of those things I think you get a little bit more safety from, given that volatility we've just been talking about.
Where do you find safety in Europe, and to what extent will the return of cash to shareholders continue to be a catalyst?
Yeah, it's interesting. You should talk about safety in Europe. FTSE 100 it is a pretty safe index relative to a lot of others in Europe. It tends to have a quite low beta, as we would term it. It's on a relatively low valuation, and as you say, it's returning money to shareholders. Buybacks are big now amongst many of the companies, particularly financials, energy, commodity stocks, etc. Now, no equity is completely safe, but I think that the FTSE 100, with its relatively low beta and its low valuation, and that sort of returning on cash to shareholders, makes it less risky than many other places. It's also a nice diversifier as well. It tends to be, it doesn't have any tech or very, very little tech, so it's not super correlated with those names, which I think will be a little bit more volatile from here.
More broadly across Europe, Sharon, do you think the French political tension that we saw, the upheaval that we saw in Paris, prepared Europe a little bit better for this volatility that we've recently seen? I'm just wondering if there was a sort of a flight away from risk in Europe as a result of that meant actually the books were a little bit more balanced going into what we saw last Monday.
Possibly, but possibly that could have been the case. Although I do think that the last couple of years, people have been generally quite cautious about investing in Europe. Ever since really Russia invaded Ukraine. Since that time, fund flows, if you look at mutual fund data, have been more or less negative into Europe every week. So yes, I think there was perhaps a bit more heightened anxiety around the French election, that people have been sceptical about Europe. Investors have been sceptical, and that's partly because of that war on in Europe and on its doorstep, raising the risk premium for Europe. But it's also because data in Europe has been weak, and European companies are very exposed to China, which, as your report earlier mentioned, has been quite a weak region. So the weakness in China, the concerns about that risk premium, and just mixed weak data in Europe, really.
Sharon, we talk to a lot of CEOs, and we continue asking the same question. Do you see a recession? And the answer seems to be generally no. Most CEOs, while they are talking about maybe a little bit of weakness, they're not seeing the R word kind of emerging as a risk for them. At the moment, we've got equity markets more broadly around the world kind of signaling still a soft landing. The bond market is signaling something more severe. What is your kind of read on this? Are we heading for a recession? Are equities being too optimistic? Are these CEOs maybe being too optimistic?
We did raise the chance, or our economists raised their view of the chance of a recession in the next 12 months. They had originally, a few weeks ago, seen it as about a 15% chance, which will put it, roughly speaking, at any random year for a recession, because about 1 in every 6, 1 in every 7 years is a recession in the case of the US. So we had a 15% chance, which is any typical year would be about a 15% chance of recession. We raised that to 25%. So we have raised it, but it's still on the lower side. In our view, actually, the labour market is pretty robust, and that's key. We think there's been a lot of distortion in the labour market because of immigration. We think underlying levels of hiring in the US are still pretty good. In Europe, we've been kind of teetering on zero, on the brink of recession, you could say, for the last couple of years. Germany has been in recession. The UK has been, again, sort of that teetering on recession level. So I think that mixed data, that weaker data in Europe has been more typical in the last couple of years. But in the US, we haven't had a recession. We think there's a 25% chance, but it certainly wouldn't be our base case.
Sharon, Guy brought up the French politics, and to what extent, to some level, that was a bit of a stress test for these European markets, particularly around political risk. As we look ahead to the elections in the US in November, how are you thinking about incorporating that risk into your strategy?
Yeah, I mean, my main focus is on Europe, but the US elections are probably the most important election for Europe. More important even than say the French election that we had this year or the UK election. I think as far as Europe's concerned, what happens with the US election is key. And it's key because there's been a lot of talk about restricting global trade. Trump has talked about imposing 10% tariffs, for example, on all goods coming into the US. Now, we don't know what the actual policies will be, whoever wins, but any restriction in global trade would be a big detriment to Europe, really. Europe is really a large open economy that relies on global trade, and especially Germany. And as discussed before, Europe has had weakish mixed data in recent quarters and really has flatlined for a period of time. So I do worry about the election and that restriction to global trade that would be a hit to Europe, I think.
Okay, Sharon Bell, Senior European Equity Strategist at Goldman Sachs. Thank you very much.
Let's talk about the core six. What are we seeing in terms of the big mega cap stocks here in Europe this morning? What are they doing? What are they delivering in terms of the performance? Broadly, we are seeing some green today. So most of the main names are higher. Ferrari in particular, definitely in gear this morning. But it's interesting to see that ASML is a little higher, despite the fact that we understand that the Norwegian Sovereign Wealth Fund may be unloading a few stocks there. But Schneider's doing well. Nestle's on the front foot. But again, there it is. Look, some weakness in Novo. It's firmed a little bit since the get-go this morning in the opening trade. But still, that stock is soft once again. What else are we watching? Let's find out. Joe Easton, over to you.
So the biggest action guy this morning is in the gambling space. A massive jump for Flutter, up 13%, the best performer on the Stock 600 today. They are reporting really strong numbers in their US sports betting business, the FanDuel business that they've been growing for the past couple of years, and also Paddy Power and Betfair in the UK getting that boost from the Euros, of course, as well. And actually, we're seeing a bit of a read-through in Entain, the owner of Ladbrokes. We can see that stock here gaining 2%. As well. In terms of some other earnings stories, TUI, now that one was up sharply on TradeGate, up around 8%, but doesn't seem to be getting the same movement. They are reporting really strong bookings in terms of most of their summer and winter bookings getting completely full out now. And then Hapag-Lloyd, you've been discussing that one, a potential easing of those rates maybe on the horizon given the spike that we've seen recently, and that would be a potential risk for the shipping company, down 4%. At the moment. Then we've got UBS at the top, up almost 2%. The wealth management business, the really big boost, massive inflows there. And the trading businesses not doing too bad in equities as well. But another one in Switzerland, one we don't look at too much, is Straumann. It's up 14%, the best performer in Switzerland, really taking the shine away from UBS. Now, this company, it does dental implants of all things, and it's got a market cap of around $20 billion. Don't know what that's saying about the health of all of our teeth, but that is a massive mover today, up 14% following earnings. Then we've got Carlsberg edging very slightly higher. A lot of the negativity priced in terms of the volume weakening that we've seen in Europe and China as well. And then E.ON down the bottom here, not too much in terms of guidance from that one, but potentially a bit of a cost increase weighing on that stock today. In terms of UK, I wanted to just check in on those names most affected by that drop in the rate of UK inflation. So the home builders, Taylor Wimpey, and the real estate firms, British Land, getting a little bit of a boost. Lloyd's edging very slightly higher, and Centrica as well, the British gas maker, really sensitive to those yields. UK gilt yields edging lower following that data. So all of those stocks looking pretty green in terms of domestic UK shares today following those numbers. We've got one M&A story to bring you. Rheinmetall buying a US truck maker, truck defense company. Of course, a lot of the defense firms in focus given the developments in Russia recently, but that stock adding to the massive gains that we've seen over the past couple of years on that M&A news. Then in terms of morning calls, we're looking at coffee once again. JDE Peet's, a big jump for that one, up 5%. Jeffrey says that their margins are looking a bit more encouraging. There's Kenco Coffee over in Amsterdam, and that one is up 5% almost today. And finally, we've done beer, so we'll end on pizza. Domino's Pizza up 1.5%. Investec says this is a stock to buy given growth in franchise. All those delicious pizzas. Domino's Pizza up 1.5% in London.
Okay, whetting the appetite. Joe Easton, thank you very much indeed from our equities team on some of the stocks on the move. A busy day, as you can see. Coming up, Norway's Sovereign Wealth Fund sees 8.6% returns in the first half, slightly underperforming its benchmark. The Sovereign Wealth Fund also trimming some of its holdings in the like of Novo Nordisk, Meta and ASML, whilst adding to some in the energy space. We break down that story for you. The details are next. This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Welcome back to the opening trade. Happy Wednesday. We're seeing gains of around 0.4% on the European benchmark. As you can see, green on the screen. It's been a big day for earnings, but also details coming through from Norway's Sovereign Wealth Fund, returning 8.6%. That's a total of $138 billion in the first half as stocks surge. The fund, the world's biggest, of course, has pared its stakes, interestingly, in Meta, Novo Nordisk and ASML. Let's bring in, at this point, Bloomberg's Heidi Skeshev in Oslo. Heidi, break down the numbers for us then. What do they tell us about the performance of this sovereign wealth fund, and maybe what it suggests about how they're positioned for the quarters ahead?
Well, as they point out themselves, the stocks are up, their stock investments are up 12%, while their investments in real estate has gone down and underperformed. And there is a continuous debate here in Norway about how much of the fund's investments should be in equity and how much should be in real estate. Should they be allowed to invest in non-listed companies? So this debate will continue with the results.
Talk me through what we're seeing in terms of the investment story and where they're investing, and more particularly where they're not investing or maybe reducing their investments. We've seen Berkshire Hathaway, for instance, recently significantly unloading on the tech front. Are we seeing some evidence that that's beginning maybe with the Norwegian Sovereign Wealth Fund?
Absolutely, and the fund's deputy CEO has concerned that there is too much investment in tech, especially the biggest tech companies. And we do see the fund released their holdings, and it shows that they have cut slightly, not a lot, but they have cut Meta, they have cut Novo Nordisk, and they cut ASML. At the same time, the fund's top 3 investments are still Apple. They've increased their holdings there. Same with Microsoft and Nvidia. So they are talking about this, and we see some slight adjustments, but no clear path ahead.
Yeah, it seems like they're taking an opposing line to Berkshire Hathaway when it comes to the Apple story. Heidi, thank you very much indeed with the latest in terms of the adjustments from that Norwegian Sovereign Wealth Fund, as, of course, it posted a gain in the first half of 8.6%, but as we've been discussing, reduced some of those holdings around Meta, Novo, ASML, but adding in the energy space. We're going to be speaking, of course, to the Norges Bank Investment Management CEO, Nicolai Tangen, always entertaining and insightful. That's 11:30 a.m. UK time, and there's been quite a pronounced move in gilts coming back to the UK CPI story.
I don't want people not to listen to what we do, but he does do a very nice podcast. very entertaining.
It's great, isn't it?
Yeah.
He speaks to some industry leaders. I was listening to one from James Gorman, formerly, of course, the CEO of Morgan Stanley. That was very insightful. Mark Zuckerberg as well, around AI. So it's worth listening in, along with all the Bloomberg.
Bloomberg has a lot of fantastic podcasts as well. But he does do a nice podcast. In terms of gilts, what are we watching this morning? Unsurprisingly, you got a bid back in the bond market here in the UK, given the inflation data that we've seen first thing this morning. The curve is moving a little bit. Obviously, we're getting a bigger move at the front end, unsurprisingly, given the fact that the market is now pricing in 2 rate cuts from the Bank of England this year. I'm assuming that's probably November and December. That seems to be certainly the thinking at the moment. Do they come a little earlier than that? We'll wait and see. Dan Hansen's going to join us shortly to run us through what we've learned from this data and what it tells us about the outlook for the central bank. Let's talk a little bit about the mining stock story as well, because in some ways it's a UK-related story as well. Some of the miners listed here in the UK are under a little bit of pressure this morning. China seems to be the narrative, and you've got this huge warning coming through from one of its biggest steelmakers, basically kind of warning of a crisis, basically, amongst the Chinese steelmakers.
I mean, the language is quite severe, isn't it? They're not holding back in terms of Baowu and one of the senior executives there in terms of the softer demand picture. So this is the world's top steel producer, just in terms of the context, the size and scope. And this is China Baowu Steel and their chairman saying that they're facing a severe winter in terms of the demand picture, a crisis more difficult to endure than we expected at a time of increased supply around iron ore coming through from the likes of Rio Tinto. So yes, you're seeing further pressure in terms of iron ore prices. $95 a tonne. It's given up about a third of the gains of the year, down 2.8% in the session, and again a further warning sign around the health of China's economy, and that links to the real estate crisis that has not yet been resolved.
And you're seeing that in copper, you're seeing it elsewhere. It's not just in the iron ore story, but it's elsewhere. It's not just in steel. It seems to be across the board, particularly. It's interesting what we did hear from Hapag-Lloyd, though, talking about a kind of boom, export boom, basically coming out of China right now. That side of the economy still appears to be very, very strong. Yeah,
multifaceted economy. The export leg of the economy has been a little volatile. We have seen some data suggesting that exports are cooling down. If you get a recession in the US, it remains not base case for most economists, of course, but if that comes through, that could prove a challenge. But as you say, interesting to see that at the touch point, at least for that shipping company, they are still seeing quite decent shipping demand out of China. Coming up, we are, of course, going to bring you back to one of the big earnings stories of the day. This is UBS, pairing some of the early gains, but of course, top-line results came in very strongly indeed, Guy, and we did see those inflows into the wealth management business. We've been hearing from Sergio Amotti.
He seems in a very good mood, according to Francine. Yeah. Life is good in Zurich right now. The plan seems to be largely on track. He is delivering. He's got some regulatory issues, which I think are going to factor into his thinking, maybe in the second half of the year. But so far, so good. And I think that's really what the market wants right now. It's just, are you able to execute on the plan? Is the integration on track? Because ultimately, if it does work, there's huge upside there. So the longer it kind of stays on track and the longer they deliver, that's great news. And the brand certainly seems to be getting some traction right now. Anyway, we'll hear more from Sergio in just a moment. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
I guess for the markets and for many investors, what happened early on this month has been a wake-up call, right? So, I mean, you look at the magnitude of the movements should make people think carefully about having a proper diversification and being very thoughtful about the way you invest money. So in that sense, the fact that we have basically made back everything within 1 week or two cannot be taken as a temporary issues. In my point of view, one has to really think that probably is a sign of some elements of fragility in the system.
But does it get easier as maybe we get a Fed cut, or does it get more complicated as we go to the U.S. election?
But look, when central bank cuts, it depends how they cut and why they cut. So if of course, there is now a capacity probably to accommodate cuts based on lower inflation, but it's also, we need to watch exactly also what are the underlying economic drivers, and to the extent that the Fed is forced to cut more aggressively because of economic downturns, that would not really be good for the market. So we need to really watch why rates would come down and how quickly they come down. In general, we do expect, and we see room for a potential rate cuts in the foreseeable future, but I wouldn't really be in the camp of predicting that the Fed will go as far as the market wants the Fed to go.
Why is that?
Well, because I think that probably the market is used to see central banks stepping in every time and being very accommodative in the previous cycles. And I think right now it's quite clear that central banks are focused also on inflation, and therefore they don't have so much capacity to go as far as the market may want to see.
UBS CEO Sergio Motti, of course, after the bank reported those second quarter net income details and numbers that, of course, smashed estimates. The stock currently up 1.2%. Let's cross over to Francine Lacroix, standing by for us in Zurich. Of course, conducted that interview with the CEO of UBS. A really sizable beat then for the business. How big a win of this is this personally for Sergio Motti, who, of course, was taken on after the merger with Credit Suisse, the takeover of Credit Suisse? Francine, good morning.
Yeah. Hi, good morning, Tom. I think it's a big win for him. And actually, he came into the interview, he was quite upbeat. He seemed quite confident, probably pleased with the results. If you look at what they've achieved, look, what's very crucial is that the bank is in tip-top shape for when extra capital requirements come, if they ever come. So if you look, for example, at cost savings in some of the units, it's extremely important that whatever they can do that's in their hands, it gets done today if they have to put more capital to one side. And this was something that he was not keen keen to talk about in terms of capital requirements, but he was keen to talk about the fact that they were very close to their clients, that they had a good quarter in terms of wealth management, that in terms of trading, everything was okay. And so he was also clear in saying, look, we've done quite a lot in savings with Credit Suisse. What we've promised, we delivered. And then the question mark is, of course, what happens in terms of capital requirements and what that means for the business model.
Francine, you bring up the issue of regulation. At the moment, the integration looks like it's on track and is delivering. Is regulation, therefore, the biggest risk around UBS right now?
It is by far, and actually it's something that Sergio Armati didn't really want to be drawn in on. He says, look, it's too soon to speculate. But remember, it was about 5-6 months ago that actually we heard from the Swiss government and Swiss policymakers that they were possibly looking at asking banks, i.e. UBS, to hold more capital. Now, then we had speculation in the media and also by investors and analysts and saying, well, how much could that extra capital requirement be? I mean, if we're talking $25 billion in extra, does that put the UBS plan in jeopardy? Does it put dividends and shareholder buybacks in jeopardy? Now, again, when you ask Sergio Armati, and I asked him not only this quarter, but the quarter before, he says it's too soon to be drawn in. He did say, in terms of timeline, they'll probably have a clearer idea, a clearer picture, by the end of the year or early 2025. What we also know behind closed doors is that he's lobbying the government. He's trying to tell them, look, they need to service clients in Switzerland and elsewhere, so they just don't want that extra regulation, because I think there's a personal belief within the bank, and certainly by the chief executive, that this is a safe bank that doesn't need any extra capital to be put to one side.
And look, Francine, clearly this is a CEO, an executive, a banking leader who's seen a number of upsides and downsides when it comes to these capital markets. The moves, of course, the stunning moves that we saw last Monday. What was his take on some of the volatility that we've seen, recent volatility in these markets?
Well, I mean, again, it's very clear that we kind of, all agreed that it was quite extraordinary moves. Now, whether this means that we're going to see a lot more volatility ahead, Sergio Armati talked about geopolitics. We mentioned U.S. politics, but of course it all boils down to the Fed. Now, today we have that U.S. CPI number that will be very closely watched. He believes that the Fed will cut. He did say that they probably won't cut as much as the markets believe, because there's an anticipation, the markets, that central banks will always be there. And he says that won't always be the case. And when you look at, again, market volatility, he talked about the need for clients to diversify, certainly in the wealth management, which fits in, I have to say, very well with his proposition of growing the wealth management business, especially in Asia and the US, in trying to get bigger and closer to clients. So for a big bank like UBS, as long as they're not on the bad side of a trade, volatility and uncertainty, especially when we go back to that 60-40 portfolio, might be a good thing for them.
Francine, great coverage, as ever, out of Zurich on UBS. Thank you very much indeed. Francine will be back throughout the morning, keeping us updated on what is happening. She'll be back in the Pulse, of course. Her show coming up very shortly. Let's turn to some of the other corporate news we've seen out this morning. Hapag-Lloyd, the giant shipper, reporting an EBIT margin for the first half of 9%. We caught up with the company's CEO and talked about kind of what freight rates are going to look like in the second half of the year.
We have seen a very unexpected spike in short-term rates over the last couple of months. I would expect that to normalize over the next 1 or 2 months. What happens beyond that at the moment is very difficult to foresee, as always.
That was the CEO of Hapag-Lloyd, Rolf Haben Jansen, joining us. Let's carry on the conversation. Brendan Murray, this is his world. Let's talk a little bit about what is happening within that world. Brendan, great to see you this morning. Unexpected seems to be a word that keeps cropping up when I talk to some of the CEOs of the big shipping companies. How much visibility do these guys have right now in terms of what is happening with freight rates, their ability to navigate the Suez, what is happening globally in terms of the demand story?
Well, if you listen to what he said, he maybe 3 months visibility is about all they have. Maybe to the end of the year, he said that they would go around the Cape of Good Hope, avoid the Red Sea attacks till the end of the year. So, but he also said that the demand that they saw that was very healthy in the second quarter is continuing in the third quarter. So, if you're looking for signs that the world economy is sliding into a recession, you're not seeing it in the numbers in global trade right now.
Molly Maersk and executives there earlier saying that they don't see those tensions and the disruption around the Red Sea clearing until, well, they see it continuing essentially into 2025. What is the longer-term impact for this shipping industry as they adjust? Even if that clears up, you've got further risks in the Middle East, you've got further risks around political tensions between China and the US, a potential Trump presidency. How do these shipping companies adjust longer term?
Well, I think the way it's going to reflect on the customers of shipping lines and consumers ultimately is those shipping rates. You heard the CEO of Hapag-Lloyd say it today. They're going to normalize, but they're not going to come back down to the levels that they were pre-pandemic, the very low levels. So they're going to come down a little bit, but it's still going to be expensive. As he said, it takes 12 ships to go from Asia to Europe right now a week. It used to, now it's 15. So it just builds in extra costs. I think that's the near-term impact.
If we were to see the Suez Canal situation opening up, say the Suez opens up and you go back to having to need maybe the 12, do you still need the 15 though, just in case it closes down again? That risk is now there. Do I have to have a bigger fleet, which means in times when, or more normal times, actually, I'm probably going to be running with excess capacity? Does this increase the volatility, the kind of the amplitude of the swings we're going to see?
Yeah, definitely. I mean, the capacity adjustments that they'll have to make fairly quickly will affect. We'll see those in spot container shipping rates. At the moment, they're still pretty elevated. They've come down a little bit. They are expected to come down a little bit more. But if they continue to go around, avoid the Suez Canal, there's a limit to how far they'll go down. The shipping lines, by the same token, have ordered a lot of new ships. They're transitioning from old fuel to new fuel ships. So a lot of those are coming online. So the bottom line is the shipping industry is going to be very volatile, very difficult to predict.
But you're going to have to run bigger fleets generally just to deal with climate change. You've seen it with when it comes to what is happening with the Panama Canal as well. Geopolitics when it comes to running with the Suez Canal as well. What is this? How big a fleet's going to have to be?
Well, it depends on what the demand is. And we're seeing good demand right now. The Port of Los Angeles yesterday said they had their busiest July ever. Wow. So if that's sustained, a lot of that is restocking. A lot of that is pre-ordering ahead of the holidays. Yeah. But if that's sustained, then the shipping lines are going to have to maintain those larger fleets.
And we touched on China with the CEO of Hapag-Lloyd, and he's actually seeing strength there in terms of shipping demand. What is the China input right now into global trade?
Yeah, exactly. I mean, China was what about the great decoupling that we were supposed to see? China is as involved in the global economy as it has been all along. There have been some disruptions at ports there, but for the most part, goods are flowing. The Port of Los Angeles executive director said yesterday they just shipped a record number of empties back to China, which tells him that those empties are going to come back across the Pacific full of goods. So we're looking at several more months of strong demand, at least in the U.S.
Are the problems on the East Coast going to affect the West Coast? I saw the West Coast having issues a while back in terms of the strikes. Is the East Coast problem now? And does that going to exacerbate some of the problems that we're seeing on the West Coast in terms of that demand story?
Right. We're 6 weeks away from the deadline for the East and Gulf Coast dock workers to get a new contract. There's a lot of talk right now that they're at an impasse. Of course, that's how these talks go. Nobody's budging until the very last minute. But that's one of the reasons why LA is seeing so much volume is the pre-ordering, the nervousness, the shifting from the East to the West Coast to avoid any potential disruptions. A short strike in the East Coast dock workers, will be absorbed fairly easily. But if it drags on for several weeks, it's the November presidential election in the U.S. as well. The stakes only get higher. So it's definitely something it's causing disruption at the moment, and it's going to get even more tense as we get closer to that September 30th deadline.
Yeah, really interesting. And you imagine there's going to be a political overlay, as you suggest, to those conversations from both parties running up to November. Bloomberg's Brendan Murray, who leads our coverage of trade and supply chains on what we're seeing globally in terms of how these supply chains are adjusting. Here's what else you need to know this morning then. Ukraine's Volodymyr Zelensky has instructed troops to prepare for more action. That's as Kyiv continues to make advances in Russia. The country's army chief says 74 villages and towns are now controlled in the Kursk region. Meanwhile, Vladimir Putin is said to have called in a trusted aide and former personal bodyguard to monitor Russia's operations to expel Ukrainian forces. And Japan is set to get a new prime minister. Fumio Kishida says he won't run for a second term as leader of the long-ruling Democratic Party this September.
今回の総裁選挙では自民党が
The LDP needs to show that it's changing and that the public can see the transformation. The best way to do so is for me to step aside. Therefore, I will not be running in the upcoming LDP leadership election. I will devote myself to supporting the new leader selected through the process as a foot soldier.
And in corporate news, Starbucks shares jumped. They soared, in fact, after the firm ousted its CEO and hired Chipotle's Brian Niccol as its next leader. Niccol starts his new role next month. The shakeout comes after activist investors amassed stakes in the company. The abrupt exit adds to a record number of CEO departures from U.S. companies. Niccol, of course, has that track record in turning around companies, including, of course, Chipotle. Coming up, as UK inflation rises less than expected, what does that mean for the consumer and the BOE? We check in on the inflation data and how that is adjusting betting around the BOE's next steps. That is next. This is Bloomberg.
Make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that you know most households where most of the dollars go against the pet, but treating, and then you start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
Wednesday the 14th, 48 minutes into the equity market session. This is how we are looking this morning. As you can see, generally bid across the screen. You've also got a bid back into the gilt market as well this morning. Stands out, really, in terms of that bid. Everywhere else, bond markets are on offer, but gilts are bid this morning. The reason for that, UK inflation increasing in July, but less than economists and the Bank of England had forecast. Services inflation posting its lowest reading in more than 2 years. Does this accelerate, bring forward, bulk up interest rate cuts coming through from the Bank of England? We've been discussing this all week as we work our way through the data that we've been getting this week, and there's been a lot of it out of the UK. Dan Hansen is back, Bloomberg Economics chief UK economist. First up, what do you make of those numbers?
So it's a weird one, isn't it? Because objectively, a rise in inflation shouldn't be good news, but when we look at it, we're looking at relative to forecasts. And as you said there, we undershot both our expectation, the Bank of England's expectations. So on a headline basis, I'd say
it's still a high number, though, isn't it? And I think that's the point you're making, maybe.
Yeah, I mean, 2.2. It's not
above target.
It's above target. It's not going to. I mean, we're not at 11% anymore. No, clearly. So it's not. It's not going to cause big worries at the Bank of England. I think the key point is around services inflation.
That's really, the point I'm making. Yeah.
And you're right. That is still high at 5.2. That is still high. And actually, interestingly, a lot of the fall from 5.7 was a lot to do with what the Bank of England likes to call volatile categories. So there's a bit of a story there about how good news this print really is. So if you strip out things like the Taylor Swift effect that we had in June, that's reversed this time. Airfares and all the bits that are a little bit more volatile month to month, actually it looks a little bit more stubborn. So I think it keeps them on for cutting it more for the rest of the year. How far they'll go, I'm not yet convinced that two more cuts is right. I think one is more likely.
You're not convinced because September hadn't really been in play for these markets up until today. And now, look, it's not base case, but it's starting to get traction, the idea that they could go in September. Prior to the data out today, it was November, and possibly 44 basis points by the end of the year.
Yes, that's right.
Now you're above that, and September's in play. So what holds them back from doing two?
I think it's that services print. I mean, if we get another CPI before the bank meets in September, so if we get a big downside surprise there, the probability would go up again, clearly. I think the other thing to remember about this is what happens over at the Fed. So the Fed meets the day before, or the decision is announced the day before, I should say, the bank meets. If Powell flags that there's a problem with the jobs market, they go 50. I think that would really raise the prospect of the bank moving in September, and it would be about putting in some precaution into the policy stance. It wouldn't be about the UK economy is falling off a cliff, we're heading for a recession. It would be about the UK economy is a small open economy. What happens in the US matters for the UK, and we're just going to put some insurance in place to be sure that we're not going to sort of fall off a cliff ourselves, if you like. So I think there need to be a few things that happen between now and then, and I at the moment, I don't think we're there. At the moment, I think November is still a reasonable base case for the next move.
Okay, but the caveats are around the Fed and around services and that part of the inflation mix with that data coming up next week. Dan Hansen, of course, Bloomberg Economics, with the focus on the UK. On the market reaction then, to a day when, of course, you've seen that surprise cut coming through from the Central Bank of New Zealand. You had the softer producer prices, of course, out of the US as well. We lead up to CPI later today. Commentary from Raphael Bostic, but nonetheless, softer CPI here in the UK. You put all that together, maybe push aside Raphael Bostic for the moment, and it looks like a more conducive and constructive moment in terms of the bond markets. And we saw money moving into treasuries yesterday. Rachel Evans from our strategy team, or rates team, talk us through what this moment is and what lessons we can draw from the RBNZ, the softer data out of the UK, out of the US, and whether or not this is something of a change in terms of how we're assessing the central banks.
Well, I think the RBNZ is an interesting one just because it shows you how quickly things can change. I mean, as recently as May, they were talking about, sort of potentially doing another hike and being, waiting to cut until 2025, I think is what they were saying. Now we've seen them come out and cut today, and they've talked about how they actually discussed having a 50 basis point cut. So it shows you just how quickly a central bank can go from talking about prospective hikes to actually cutting and thinking about big cuts. And I think that's where it's kind of relevant to how the market is really viewing this setup for US CPI. Given we had so many gyrations in the market last week, and there was a real kind of sense that, that the US economy was faltering, that we were heading sort of really rather quickly towards a recession environment, and that the Fed was going to have to cut quickly, maybe even before they got to their September meeting. We've kind of got this situation position where we're kind of going into CPI, with people looking to that as really sort of vindication or sort of, you know, proof that those perceptions have some merit. And I think kind of, you know, what the RBNZ told us was that, yeah, these things can change pretty quickly. And if we do see CPI really showing some softness in the wake of kind of some of the jobs data also showing some softness, that could be enough to kind of give the green light to traders that, yeah, you know, the Fed's going to cut in September and it could cut really big.
How much of that's already priced, though? Like, bond markets are signalling already that we are in a fairly dismal picture, or we have a dismal sort of outlook picture. Where is the risk? Is the risk that actually the number undershoots today? Do we get a kind of, how asymmetric is the reaction? Do we get an overshoot in terms of the number? Do we get a bigger reaction on the upside versus a downside miss?
As you can imagine, this is something I've been trying to figure out this morning as we're kind of preparing for the release. Honestly, I think there's a risk either way, because we have seen a pullback from some of the durations we saw last week. We're about 80% priced for a 50 basis point cut in September, which is pretty out there. Like, that's, you know, given what Powell was saying at the last meeting, that requires a very large pivot. We do have Jackson Hole coming up next week, where we may get more of a sense of whether that's something that they would contemplate. But, you know, that's where the RBNZ does show how quickly these things can happen. I would say, given how long the Treasuries market is now, and we are seeing kind of open interest in 10-year futures at a record high. We're seeing, I think JP Morgan had a client survey out this week showing that you know, their clients are the most long since December. Everybody is positioned for more rally, for more cuts to be priced. That seems like we might be over-egging it a little bit, given where Powell was very recently. So I think there's going to be, you know, potential, if we do see CPI come in, you know, as people are hoping and expecting, there could be quite a big rally. That's where people are positioned. That's where the market wants to go. But if we don't see that, they're so positioned towards the longs that there's going to be some covering. So it could be quite a sharp move either way.
The BOJ clearly was central in terms of tripping up the markets last week, one of the key factors. Now we have change at the top coming through in terms of leadership, the Prime Minister stepping down and a new leader as yet unknown to take over the helm. I wonder how much policy uncertainty there is then, given the linkages between the Prime Minister in Japan and the BOJ.
Yeah, I mean, it's a really good question. I think the market is still trying to pass through exactly what this means. Like, markets hate uncertainty. Any uncertainty is always a reason to sell. But looking at the markets today, like, dollar yen is pretty stable. But what they're going to really want to look to see is that there is a path of certainty kind of coming through in coming days and weeks. Like, the Prime Minister who's outgoing was very unpopular, got really hammered by, you know, obviously some domestic scandals around slush funds, but also inflation and that weak yen. So they're going to want to be listening for some of the rhetoric that comes out of the potential candidates to replace him. Where do they stand on the yen? Do they want a weaker yen, or do they see kind of having kind of a strong yen and the yen having weakened too far as something that they want to kind of push back on? So I think it's going to depend a lot on what the commentary is that kind of comes out from those candidates.
Fantastic as ever. Rachel, nice to see you this morning. Thank you very much indeed. Busy day coming up with the US CPI data to drop a little bit later on. Some great coverage coming from Bloomberg. Let's talk a little bit about what is happening with the markets right now. UBS, let's quickly check in. It's faded the early move, certainly from first thing, but we are still up over 2% on that stock story. Novo, I've been questioning why the stock has been down over the last few days. Somebody suggesting on IB to me this morning, maybe you could draw a line between the Norwegian Sovereign Wealth Fund selling and maybe some of that weakness coming through. But as you can see, the stock's not done that badly. Francine is up next. The UBS story front and centre. She's in Zurich. This is Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars. Only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Zurich. Here's what's coming up on today's show. European stocks rise on bets that today's U.S. consumer price report will allow the Fed to start cutting rates in September. UBS rallies after beating expectations with net income in the second quarter coming in at double estimates. We'll have more from our interview with the chief executive, Sergio Armati, in just anticipation. Plus, Japanese Prime Minister Fumio Kishida announces he will not run for a second term, while traders already speculating his successor could make it easier for the BOJ to raise rates at a quicker pace. Now, a couple of things we need to keep an eye on. Of course, it's all about U.S. CPI. We have a lot of earnings. We spoke to many chief executives today, but European stocks overall tracking in advance. Actually, what we saw in Asia on bets that the U.S. consumer price report will allow the Fed to start reducing interest rates in September. Now, UBS definitely leading some of the gains, maybe a little bit less than they did at the open, but again, leading gains in European financial services. Again, this is after the bank's second quarter profit actually beat estimates thanks to strong client inflow, but also investment banking revenue. Miners dropping a touch, iron ore slumping, and then I'm looking at a couple of other things, including yen pound actually falling against the dollar after UK inflation data came in below forecast. Yen 147.39, you can see pound, and then Brent crude 81.14. So back to corporates and UBS. The reason we're here in Zurich has delivered a big profit beat in the second quarter. Its net income, $1.1 billion, was more than double analyst estimates. Now, Chief Executive Officer Sergio Armati spoke to us earlier about the results as well as capital reforms after the takeover of Credit Suisse.
Well, first of all, I'm proud that we made very good progress in the integration, and so we significantly now reduced the risk of the integration itself. And we did that while staying close to clients, deliver very good financial results, which makes me comfortable that we are on a good way to deliver on our 2026 financial targets. Of course, it's going to take a lot of time to restore the profitability because the amount of tasks to be done is huge, but I'm confident that we are on a good way to deliver.
There's always this overhang about the capital requirements that regulators are talking about. You've been very vocal about it. How do you see it playing out?
Well, look, we started technical discussions with all interested parties. We will see how it comes out. I think that we are all for making the system more resilient, more safe. On the other end, we have to recognize that the current system has served us well, so much that we were able to step in and rescue Credit Suisse. So we need to look at the lessons learned from this crisis, but also on the other end, we need to ensure that the outcome is proportionate and is also one that allows us to continue to be a driver of growth and well-being for the Swiss economy.
So your biggest concern, I mean, at any point, could it touch dividend or shareholder buybacks?
I don't think this will happen. I think that in any case, it's premature to speculate on the outcome.
I know that there's a number of ways, of course, of dealing with this if something big were to happen in this space. One of them is probably SRT deals. Are regulators, have they given you a green light on them?
No, well, look, I don't think this is SRT are something that can be used in a focused and selective way to manage economic risk and not to manage regulatory capital issues per se. So in that sense, I don't think it's a solution.
So is there a solution that you're looking at to kind of minimize the impact on UBS?
I think it's premature to speculate because we don't know really the outcome of the discussions. We will find out probably late this year, early part of 2025, the direction of travel, and then we can make an assessment.
Sergio, talk to me a little bit about wealth management. So there's been a number of, high-profile people. Iqbal, for example, is moving to Asia. What's your biggest hope for wealth and in what region?
Well, Iqbal has moved to Asia with his family, so I think we continue to see Asia, China, and the U.S. as a big driver of growth. They are very important elements of our strategy, together with our position in Switzerland as a leading universal bank. And you saw also in the second quarter results, but overall that Asia continues to be a pretty good secular driver of growth for our business.
What about the U.S.?
The U.S., we are. I'm glad we are making good progress with some initiatives to make the IB and wealth management working closer together. This has helped our transaction activities in wealth management. We are also preparing the platform to institutionalize more of our client relationships. So, and now with the new leadership team, with Rob Karosky, we are really preparing for the next phase of our plans, and I'm confident that we will improve our results in the U.S. In the foreseeable future.
Quite quickly, how aggressive do you want to be in the U.S. in terms of
I think we have a plan, and we set our plan that we believe we need to get to mid-teens pre-tax profit margins in the next two or 3 years, and then from there onwards we will look at ways to improve further. But it takes time to do that. Of course, the environment is not really favorable. We need to do things with sustainability in mind, and not just to aim to do quick wins.
I mean, are you looking at potential acquisitions, or will most of everything will be through organic?
No, we have to do our own work and fix the issues we need to fix, and leverage better the capabilities we have right now, and they are enough driver of growth and for us in the foreseeable future.
Do you see any M&A on the cards? I mean, are you ready to acquire even something small?
We are quite busy with M&A right now, so it's difficult for us to think about M&A. So I think that we have enough on our plate.
Sergio Armani there, the UBS Chief Executive Officer, speaking to me earlier. Now, investors watching for key U.S. CPI data, hoping that a smaller increase will cement a September rate cut. Now, this comes after the Atlanta Fed President Raphael Bostic said he's looking for a little more data before supporting a reduction in interest rates. Now, Bostic emphasized that it would be really bad if the Fed had to change course once it begins cutting. Well, let's talk now to Charlotte Ryland, Head of Investment at CCLA Investment Management. Charlotte, thank you so much for joining us today. All eyes, of course, on U.S. CPI, but does the volatility we saw last week change any of your investment calls?
No, I mean, to be honest, I think, we've had a huge amount of moves from markets, but actually I think fundamentally what's happening in the economy and interest rate expectations probably shouldn't have changed all that much. I mean, I think there's been a lot of speculation about, slightly softer labour data, clearly some signs of a bit of slowing down in terms of consumer, but I don't think there's anything that's really pointing at the moment towards a recession. And you'd need a recession to actually see, very significant moves down in interest rates. I mean, it's entirely possible we have slightly PPI today, and therefore that might lead to a cut. But I think these expectations of 5, 6, 7 cuts that the markets are starting to price in, I think it's probably a bit too optimistic.
Yeah. So why is the market too optimistic in your eyes? Is there? We're just speaking to Sergio Ramadi, the chief executive of UBS, and he's like, there's a concern that actually the markets are just too reliant on central banks and expect them to do all the work for them.
Yeah, no, I think we've all got so used to what back in the day was the Greenspan put, wasn't it? But the markets were, as soon as the markets had a sell-off, that central banks would rush back in. But I think what's different today is that we've had an inflationary period. Central banks are clearly very worried about that still. There's still a bit of heat particularly in terms of service inflation, and I think they're going to remain reasonably cautious. So we've seen the Bank of England move once, maybe they may move again sort of into the autumn. But these expectations of a lot of rate cuts, unless we have much more seriously wrong with the economy, I suspect a bit optimistic.
Charlotte, given the sell-off we saw last week, is now a good time to get back into tech, or have you never really let it go?
We were trimming sort of over the summer, some of our positions, but it is still an area that we have quite a lot of exposure to, and I think the key development at the end of the month is clearly going to be the Nvidia numbers and whether they can continue to show that sort of very, very dramatic growth that they have done. But areas like software have had quite a difficult year actually. They haven't, companies like Adobe, companies like Fortinet, haven't had a steady year, but the numbers are continuing to look quite attractive. So I think if you look beyond the Magnificent Seven, actually there are still some interesting companies out there still producing very good growth.
When you look at some of the consumer pressure, I don't know whether you're expecting more consumer pressure or it's a tricky business, for example, for luxury because of the weakness we're seeing in China.
Yeah, I think certainly luxury, a lot of the players like Burberry, of course, have had an extremely difficult time. Partly that's a little bit to do with their own brand positioning, but equally sort of like Kering with their Gucci brand have really struggled. So I think, the place to be probably within luxury at the moment is the very high end level. So things like a Hermes, for example, which really control their supply of goods, continuing to be able to, get pricing and get reasonable demand for their products. But, more generally, it is going to be difficult. And that's not just China. It's also a bit of a slowdown in the US where I had, a lot of spending post-pandemic. But of course, those pandemic checks are going to run out.
When you look at healthcare, is there anything driving? Some of the big companies are doing quite well, but it's all because of drug discovery. We also have the U.S. election. That's probably the big one this year, and it's unclear how much government spending will go into, for example, healthcare. So where do you see opportunities in healthcare right now?
Sure. So, I think, still the sort of life science tools companies which have, had a bit of an overhang from the pandemic where there was an awful lot of spending on drug discovery, but, diagnostics and all of those kind of tools as well. They've had quite a difficult time with destocking. I think they're looking more attractive now to, Thermo Fisher's, the Danahers of this world. Within pharmaceuticals, it remains, there's a few companies out there, Novo Nordisk, Lilly, AstraZeneca, up to new highs as well, where they have got that decent pipeline. But, we probably prefer to be playing some of the more device end of things and some of the life sciences rather than just pharma names.
So, Charlotte, I know you really break down your kind of market analysis by industries and sectors. Are there any country analysis that makes you prefer a stock over the other? And where do you put the UK right now?
No, I think, China remains an extremely difficult economy at the moment. I think that continues to be an overhang for businesses that have a large exposure to that. We're reasonably positive in India and the growth story that can continue there. But we're investing globally, and so that's not geographic sort of allocation is not particularly something for us. In terms of the UK, there are some really interesting companies within the UK market. So things like London Stock Exchange, things like Ashtead, which are really exposed to some of the infrastructure spending that's going on within the US. So there's some interesting opportunities within the UK. Even if, there's a larger market cap companies, perhaps not quite so attractive.
Charlotte, thanks so much. Charlotte Rylander from CCLA Investment Management. Now, coming up, we'll have plenty more. Of course, on the Middle East, U.S. Secretary of State Antony Blinken reportedly delays his trip to the Middle East due to regional uncertainty. We'll get the latest with Sanam Vakil from Chatham House. That's next, and this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
U.S. Secretary of State Antony Blinken has reportedly postponed his latest trip to the Middle East despite a flurry of diplomatic activity in a renewed push for Gaza truce talks. Now, for more, let's bring in Sanam Vakil, Director of the Middle East and North Africa Program at Chatham House. Dr. Vakil, thank you so much for joining us. I don't know whether it means that there's something being defeated because the Secretary of State has postponed his trip to the Middle East, or whether we're expecting something big to happen in terms of retaliation.
Good morning. Thank you for having me. Well, I think that there's a lot of uncertainty right now. Over the past few days, we've heard reports that an Iranian escalation and response to the killing of Ismail Haniyeh in Tehran is coming. And that escalation could not just come from Tehran, but also from Hezbollah and other actors that are part of the Iran-backed axis of resistance. And this escalation is perhaps going to impact the ceasefire talks that are meant to begin on August 15th in Cairo. So there is a big push for diplomacy and for this ceasefire to finally be obtained after 10 months. But at the same time, it's unclear how the Iranians are going to respond. And that could explain the delay in Secretary Blinken's trip.
What do you think the chances of a ceasefire at this point are?
I think it's really slim, to be very honest, and I'm sorry to be the bearer of bad news, but 10 months on from the war in Gaza, the leaders of Hamas, Prime Minister Netanyahu and President Biden, are not all on the same page. Yahya Sinwar, who has also stepped up into Ismail Haniyeh's shoes after his assassination in Tehran, is looking for a permanent ceasefire and is looking for a plan to be implemented immediately to address humanitarian issues, but to stop the war. Benjamin Netanyahu on the Israeli side, however, has to address Israel's security crisis, and Israel has a domestic security crisis with Hamas still alive and lobbing rockets over into Israel. But also it has a crisis on its borders with Hezbollah also shooting back and forth on the northern border, and tensions with Iran are still quite heated. So he's not looking for a ceasefire, all of this to say. So with these timelines very far off, and with the objectives of each leader also far off, it seems unlikely that a ceasefire will be met so quickly, unfortunately.
But Dr. Vakil, we also heard yesterday from U.S. President Joe Biden that he believed that actually a possible ceasefire could prevent an Iranian attack on Israel. If Iran is showing this also to show a tour of force domestically, are the two linked?
Well, yes, to a certain degree it is linked. Iran and the axis of resistance have maintained that their military activities in response are in order to push for a ceasefire. They believe that with a ceasefire, and they've stated as such, that the escalation in the military domain will come to an end. And so that's what they're pushing for. They don't want to compromise the ceasefire, or they don't want to be seen to compromise a potential ceasefire. So that could explain why Iran is holding off and dragging out its response. We're in a 2-week window now, and my expectation is that Iran will wait a few more days to see what happens with the ceasefire talks. But at the same time, of course, there is domestic pressure in Iran. Iran's conservatives and hardliners believe that Iran's sovereignty was breached when Haniyeh was killed in Tehran. It was also hugely embarrassing that on their watch, Israel was so successful at taking out a high-level Hamas official. So in order to address Iran's deterrence in the region, a response is needed.
Dr. Vakil, I mean, it is also, you know, heartbreaking every day to look at the loss of civilian lives in Gaza and elsewhere. How does the game change after the U.S. election? What does it mean for civilians in the region?
I think you're so right to bring up the human side of this war and conflict that too often is forgotten. Gazans, Palestinians are being bombed every day. There is a humanitarian catastrophe underway, famine. I was just reading a story this morning about how girls and women are cutting their hair because they just don't have brushes and combs to brush their hair. So, you know, things are very grave. And there needs to be urgent international attention and pressure brought on both Israel and Hamas in order to bring this to a close. I think that's imperative. Going into November, I think there is a lot of uncertainty. Kamala Harris, the Democratic nominee and vice president, has taken a much more critical line towards Israel's lack of regard for civilian life. But it doesn't mean that the U.S. position and strong support for Israel is going to change. That relationship is intrinsic. It's key. And I think that that will be very much, and perhaps a Democratic win in November could lead to further support for Palestinian statehood that we haven't seen from the United States in a meaningful way. But President Trump, on the other hand, hasn't really made clear his long-term.
All right, I think we're seeing a couple of difficulties actually to connect Dr. Vakil. We'll have plenty more from her a little bit later on. Sanam Vakil there from Chatham House. Coming up, Carlsberg increases its profit growth outlook for the year as its cost-cutting offsets weak demand. Our interview with the Danish Brewers chief executive is next, and this is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
We, just like every other consumer goods company, have been hit very hard on the weather front towards the end of the quarter. At the same time, I have to say the underlying European consumer has stabilized, and we are cautiously optimistic around the European consumer. But we're not out of the doldrums. But it's not like we're deteriorating further from here.
Well, that was the Carlsberg Chief Executive Officer speaking to Bloomberg. Now, coming up, Sergio Armati, the Chief Executive of UBS, gives us his view on recent market volatility, potential rate cuts from the Fed as well. More of our conversation next, and this is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in Zurich, and these are your top stories. European stocks rise on bets that today's U.S. consumer price report will allow the Fed to start cutting rates in September. UBS rallies after beating expectations with net income in the second quarter coming in at double estimates. We'll have more from our interview with the Chief Executive, Sergio Armati, in just a moment. Plus, Japanese Prime Minister Fumio Kishida announces he will not run for a second term. Traders already speculating his successor could make it easier for the BOJ to raise rates at a quicker pace. So the chief executive of UBS says recent market volatility is a, quote, wake-up call for investors to diversify their assets, while Sergio Armati spoke to me earlier today after the Swiss bank posted a big earnings beat.
For the markets and for many investors, what happened early on this month has been a wake-up call, right? So, I mean, you look at the magnitude of the movements should make people think carefully about having a proper diversification and being very thoughtful about the way you invest money. So in that sense, the fact that we basically made back everything within 1 week or two cannot be taken as a temporary issues. In my point of view, one has to really think that probably is a sign of some elements of fragility in the system.
But does it get easier as maybe we get a Fed cut, or does it get more complicated as we go to the U.S. election?
But look, when central bank cuts, it depends how they cut and why they cut. So if of course, there is now capacity probably to accommodate cuts based on lower inflation. But it's also, we need to watch exactly also what are the underlying economic drivers, and to the extent that the Fed is forced to cut more aggressively because of economic downturns, that would not really be good for the market. So we need to really watch why rates would come down and how quickly they come down. In general, we do expect and we see room for a potential rate cuts in the foreseeable future, but I wouldn't really be in the camp of predicting that the Fed will go as far as the market wants the Fed to go.
There's been a lot of focus on private markets. How does that interplay actually change, and what does it mean for UBS?
No, the big change in client behaviors we saw in the last 24 months was clearly more diversification towards fixed income and so on and so forth. When rates comes down, of course, maybe part of it will go to search for higher yield maybe in private credit, but not only. But we do believe that as rates comes down, you will see also potentially people moving back to more alternative assets, and also, which is important to understand, the headwinds we face in the industry, but also at UBS in NII, in margins on interest rates, will be also offset by clients taking more leverage potentially. So it depends how it plays out. It depends what are the underlying economic dynamics.
But so do you worry that there could be a systemic risk or semi-systemic risk?
I don't think so. No, I don't think I don't see systemic risk, but volatility does. High volatility doesn't mean that you have systemic risks.
But what does it mean? High volatility means you need to be
higher
on the right side of the trade?
I mean, to be honest, I think if you look at high volatility can be an absolute or a relative concept. So because we have seen so low volatility in the last few quarters, I do believe that we're going to see higher volatility. If this is very high and permanently high, it's another matter, but I do believe we're going to see more volatility.
So it can't be quarterly results if I don't ask you about hiring or actually job losses. Can you give us an update on what the next 6 and then 12 months will bring?
Well, you saw that, the restructuring and fixing the elements of problems in the integration are unfortunately driving job losses. We took down around 3,000 headcount this quarter, so I think that we will continue to have to do that in order to restore the profitability UBS had before the acquisition.
Well, that was Sergio Armati, the UBS Chief Executive Officer, speaking to me a little bit earlier on. Now, our finance reporter who covers UBS here in Zurich is with me, Miriam Belezu, and Paul Davies, global banking columnist at Bloomberg Opinion, is also joining from London. So thank you both for joining us. Miriam, I mean, we were together this morning when the earnings came out. Sergio Armati was actually, of course, in a pretty good mood given the results, but I guess the big elephant in the room, or the big overhang, is what happens to capital requirements.
Absolutely, and surprisingly, there was no mention of it, or very little update anyway, but this is definitely something that will kind of hang a cloud that hangs over the bank, because there is still uncertainty. We're still waiting to see what the Swiss government will decide, but that's going to be a big bill for UBS, so something that it cannot just disregard. They have announced last quarter that they're adding an additional 20 billion of capital, so that would come on top of that, and it's non-negligible sort of amount.
So, Paul, what's your take on this? When you look at the capital, requirements, again, I mean, this could be 25 billion. It's not something that can be ignored, and yet it seems we don't have a timeline, we don't have the amount, and we don't really know behind closed doors how much lobbying UBS is doing.
I mean, I'm sure they're doing plenty of lobbying behind closed doors, but it's. I think they said that they expect to have much clearer idea by the end of this year or the first quarter of next year. So that will be helpful. I mean, the main problem here, or the main issue, is going to be the treatment of a lot of foreign subsidiaries. That's where they're worried about, the regulator taking a much stiffer stance than the Basel III kind of global requirements demands, and maybe kind of taking more of that away from their core capital as well, kind of like not only having a higher requirement for it, but also imposing that requirement in a tougher way. So, I mean, it's still very, very unclear about how much money that would mean. I don't think it would be as much as 25 billion, but hopefully by the first quarter that will all be much clearer.
Yeah, and it's interesting, Miriam, because I did try and ask Sergio Armati a couple of times, but he says, look, it's too soon to speculate. He doesn't want to speculate. And I don't know whether he just doesn't want to give the markets something to worry about, given that internally, whatever they can do, they seem to be trying to.
Absolutely, and I think they have a rough idea of the magnitude of the amount that will come. But on the analyst call just earlier, Sergio Armati and Todd Tuckner were talking about kind of a short-term disadvantage for them in Switzerland, definitely. So they are aware, and this is a big topic, and I think we'll have a lot more clarity in the coming month. But there's definitely conversation behind closed doors and a lot of lobbying happening.
But we've also seen some changes in wealth management. So you have Iqbal Khan being sent to Asia, where they really want to grow. There's also a lot of focus on the U.S. How difficult is it going to be to grow in this crowded space?
Well, obviously, it's very competitive. I mean, I guess there's a couple of things to watch. As interest rates come down, it will be their ability to convert cash balances, deposits into higher fee income kind of management accounts, which will be quite important. I mean, especially in Asia, they've done very well at holding on to a lot of Credit Suisse clients out there. In the US, it's a different story. Obviously, it's a very, very competitive market. They don't really want to go down market. They don't want to go away from their kind of core, ultra and high net worth clients. But they do need to sort of find some way of expanding their distribution. And I think maybe once this integration is done, they might look at more ways of other businesses, other ways in which they could distribute more products to their clients and to new clients, and maybe some kind of acquisition or something further down the track.
Miriam, I know that overall, of course, it was a good quarter. The shares rallied, and then they, I guess, recouped some of these gains, and then they're now back up to around 2%. Were there concerns about some underlying weaknesses in divisions, including wealth management?
I think it was more confusion around the mix around the beat this quarter, because it wasn't as clear. It wasn't their core businesses and divisions that have outperformed, but rather the NCL, which is the winding down, and the IB, obviously. But in terms of wealth management, their bread and butter, and PNC. That was where it wasn't as really positive as expected. So I think it was just a reaction from the mix of the beat. But getting back there, and I think the market's quite forgiving this morning.
Yeah, and wealth management, I mean, it seems okay, right? That wealth unit, you're seeing inflows, you're seeing clients, I guess client activity definitely not going down.
Yeah, which was quite surprising to see and very positive in the light of the current kind of geopolitical tension. So this was definitely a positive, but rest to be seen for the second half of the year.
Paul, this is probably, the biggest, if not the hardest job in banking, together with the chairman. What kind of report card would you give leadership at UBS on the integration of Credit Suisse?
Well, I think it's going much better than expected, and certainly much quicker than expected. And as Miriam was saying, it's the non-core book where they're really making much faster advances than they said they would, and that's helped to get them to their kind of cost savings targets much quicker as well. So, I mean, obviously, Sergio Amotti has come back to kind of do this job and is kind of forcing all of his staff to execute it well. But the woman who's in charge of the non-core business, Bea Martin, who is one of the outsiders maybe to succeed Sergio. I mean, she's obviously performing incredibly well, getting this NCL stuff done much faster than was expected. So that's great for her and great for Sergio.
Yeah, and there's always, Miriam, a lot more that needs to be done. But is there anything that we're looking for in terms of unwinding or a lot more job losses? Again, quietly, there have been jobs that have gone in certain divisions and parts of the company.
Absolutely. We saw quite a high number, actually, of headcount reduction in the past couple of months. So that was quite surprising to see that this is going at a faster pace than anticipated. But there's plenty of other assets from Credit Suisse that UBS wants to exit. And we've seen a transaction that they've announced yesterday on the mortgage services side. So we can expect a lot more of that, and just an acceleration of the wind down of the NCL business, and also obviously the winding down of the shrinking Credit Suisse's UBS investment bank in the US.
Paul, how bonuses always figure as one of the top questions also for a lot of these chief executives. How easy for UBS is it to attract top talent right now?
I guess it depends on the area. I mean, I think that they are, one of the things about the Credit Suisse deal is that they got a lot of investment bankers, which, at one time, one of the executives there, they said to me, it's like having a free hit. You've got a bunch of people who've come in who need to prove themselves, who are not on any kind of promise because you've not hired them. They've just sort of landed there. And so they had all of these people who were, I guess, wanting to work hard in order to keep their jobs, in order to give themselves a future within this bank. And so that's kind of, I mean, that's a great motivating factor in itself, right? And so, perhaps their need to hire isn't so great as others. It's, for a spell they were going through, they were trying to get rid of people more than hire them necessarily. But yeah, so they've got I guess plenty of energy and they might need to upgrade some people in some areas, but they've got plenty of motivation among the people that they've already got to try and improve the business that they're doing, I suppose.
So interesting. Thank you both for joining us. Our finance reporter, Miriam Belezo and Paul Davies, even if Paul did not get the white linen memo jacket, but great content, as always, from Bloomberg Opinion. Now, the chief executive and the deputy of the Norges Bank Investment Management, the world's individual biggest holder of stocks, is giving a press conference on their first half results and changes to their holdings. Well, you can continue to watch that on LiveGo on your Bloomberg terminal. Then we'll be speaking with the Norges Bank chief executive, Nicolai Tangen, at 11:30 a.m. UK time. It's always a great interview. It's never dull. Mr. Tangen saying just minutes ago that it will be difficult to generate returns ahead. Coming up, Japan is set for a new leader after the Prime Minister, Fumio Kishida, announces he will not run for a second term. We look at the possible successors. That's next, and this is Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Now let's turn our attention to Japan because it's set to get a new prime minister. Fumio Kishida says he will not run for a second term as leader of the long-ruling Liberal Democratic Party this September.
今回の総裁選挙では自民党が
The LDP needs to show that it's changing and that the public can see the transformation. The best way to do so is for me to step aside. Therefore, I will not be running in the upcoming LDP leadership election. I will devote myself to supporting the new leader selected to the process as a foot soldier.
Let's bring in Roz Matheson, Bloomberg's EMEA News Director. Hi, Roz. So Kishida was relatively popular when he took office almost 3 years ago. What went wrong?
Well, he was, as you say, quite popular when he took over. And obviously this news means that he will no longer be LDP leader at the party election. Whoever leads the LDP, the ruling party, becomes prime minister, or at least the candidate also for the further election. And he came in being quite popular, but things went pretty awry. In fact, his popularity has been falling and falling for many months. And things that he's done, including tax rebates, haven't really seemed to resonate with voters. They'd be concerned about where the yen is. They'd be concerned about inflation. But also they've been concerned about this sort of long-running, all-consuming scandals involving the ruling party, including about these sort of slush funds, these political donation funds. They're quite obscure. They're tied to individual politicians. They're tied to factions in the LDP. And they're very, very opaque. And the question is, are these funds all above board? Are they declared? What's the process for them? And even though they've existed well before Kishida, he has been around when they really burst into the public consciousness, and he hasn't managed to really manage that situation with those slush funds and with voters in general. So that's hit his popularity. So in a way, the fact he's decided not to run at the party election is not that surprising. The question now, of course, is who will replace him?
That's $1 million question. And so who do you think is most likely to replace him in September, and how will they differ on policy?
It'll be interesting to see. I mean, right now, there's no absolute front runner. I mean, Shigeru Ishiba is probably the one. He polls quite well with voters in general. He's just never had the factional heft to become the prime minister or the leader of the party, but he polls very well with voters, and he's seen as someone who can resonate with voters in general. He's a pragmatist when it comes to foreign policy. He's had years of experience in Japanese politics. He's sort of in alignment with the BOJ or normalization, but really there's not that much daylight between any leader of the LDP on economic policy. This is a slow-moving, conservative, careful party that tends not to make sudden changes in policy when it comes to the economy. So you wouldn't expect to see massive shifts there, whoever is in charge. You might see a little bit of a difference around how they approach the BOJ. I mean, some of the other potential candidates have been pushing the BOJ to be more transparent about the trajectory around interest rates. So there might be a bit of something there. Some of the candidates tend to be more hawkish on foreign policy. There's one who was a former heavy metal drummer who's now become a hardline conservative, Asane Takeichi, and she would take a very hard line on things like China, for example, so you can expect tensions with China if she were to become prime minister. And of course, the relationships, you know, for Japan with the US and China are both very important. But on economic policy, not a lot of change between any of them.
Roz, thank you so much, as always, for the terrific insight. Roz Matheson, Bloomberg's EMA News Director, of course, sharing her thoughts. Coming up, we reveal the U.S. Justice Department is considering a rare bid to break up tech giant Google after a landmark antitrust ruling. We'll bring you our scoop next, and this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back, everyone. Now, Thailand's constitutional court has dismissed the Prime Minister, Srettha Thavisin, from office after finding him guilty of an ethical violation, throwing the country into fresh political turmoil. Now, the court said the Prime Minister's appointment of a former lawyer who was once jailed for alleged bribery violated ethical standards. The court's decisions are final and cannot be appealed. So we look at Thai baht, you can see, against the US dollar, 34.978. Now, the US Justice Department is also saying, or is said to be considering, a rare bid to break up Alphabet's Google after a court ruling found the tech giant monopolized the online search market. It could be Washington's first push to dismantle a company for illegal monopolization since unsuccessful efforts to break up Microsoft 2 decades ago. Well, Bloomberg's Tom McKenzie joins us now. Hi, Tom. Great to speak to you. So what more are we hearing from sources?
Yeah, look, Fran, you put it in that historical context for us. This would be momentous if the DOJ, the Department of Justice in the US, goes ahead with this push to break up Google, of course, in terms of what they could be looking at. It would be the nuclear option if they go down this route. And that could include divesting, for example, the Chrome web browser, but also the operating system, Android, from the rest of the business. It's not certain yet that they will go down this route, but the fact that they are considering it is highly significant. And as you say, it will be the first time they've attempted to do this kind of breakup of a major company since Microsoft about 2 decades ago. So we'll see where they land on this. There's a dual track process as well, because the time frame is getting closer. There will be a process in the next month or so where remedies around what the judge found in this most recent case, where they ruled that indeed Google had been a monopoly. That time frame is coming closer. They have to come up with these remedies. And what the findings came through from that judge was that Google paid for these exclusive contracts that allowed them to monopolize the search part of their business, about $29 billion to the likes of Apple and Samsung. So we'll see what the remedies end up being. The most severe one would be a breakup of this business.
Tom, thank you so much. Tom McKenzie there with the very latest on Google. Now, a reminder, we'll also be speaking with the Norges Bank Chief Executive. That is Nikolai Tangen. That's at 11:30 a.m. UK time. Up next, Bloomberg Brief. They'll have a full roundup of what's going on with the US CPI. That's a little bit later today. We expect market expectations. Then we have a lot of earnings. Welcome to earnings season, when we have about 5 to 10 chief executives exclusively every day. So enjoy. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning from our global headquarters in New York. I'm Manus Craney. You're welcome to Bloomberg Brief. Let's set your agenda. Cementing the Fed cut, markets count down to the CPI as producer prices deliver another brick in the disinflation wall. UBS produces a punchy beat on profits and progress with integration. Amati doubles down on $1 billion buyback this year. And make up and break up. Mars inches closer to a deal to buy Kellanova as the DOJ mulls breaking up Google following an antitrust win. A very good morning to you. You had the PPI come in yesterday. The groundwork that plays into PCE was good. It was tame. It built the narrative that you're getting closer to a 50 basis point cut in September. S&P 500 had its best four-day run higher of 2024. What happened last Monday? You know, where is your memory? We are flea-like in our memory. Still, the Russell lags the rest of the market. 40% chance of a 50 basis point cut. And Bank of America's clients are net buyers for the first time in over a month. Google this morning, Alphabet and Google down Alphabet down 1.35%. Interesting, the stock closed up yesterday. It's a little bit lower this morning as Europe digests the various remedies that may be delivered by the DOJ mulling to seek a breakup of Google. If that happens, wow. Bond market, I had a quick look at this. We're down 8 basis points so far this week. And again, the trajectory is for the PPI, the services dipped, that plays into the narrative. The CPI should be well behaved. Recessionometer from Goldman's is up a tick higher at 41%. JP Morgan raising the probability as well, although Bostic wants a little bit more time. I go to iron ore. There is a salary warning from one of the biggest steel producers out there. Buckle up. You're going to have downturns in China and this market, like 2008 and 2015. A severe winter is coming. Maybe that's a more prescient warning to the rest of the narrative for growth around the world. My guest today is Principal Seema Shah. She weighs in on this very topic of recession and the odds. And this is what she says. Our view remains that household and corporate balance sheets, strength implies recession is unlikely, but the risks are building. If economic data continue to deteriorate, the Fed stands in a good position to respond aggressively. Let's contextualize what an aggressive response mechanism is. Seema joins me now. Seema, if I look at the PPI, it laid the table for an optimistic call on the CPI today. You talk about the potential or the ability to deliver an aggressive response. My question to you would be simple. An awful lot has got to go quite wrong to deliver an aggressive response. Isn't that the case?
Hi, Manus. Yes, I would agree. And actually, our expectation is that you're not going to see the need for the Fed to react aggressively. But I think what is reassuring, or it should be reassuring to markets and anyone that is concerned about recession, is that the Fed has a lot of room to cut rates. You know, we're not back to where it was 5-10 years ago, where they were almost at the zero bound and we only had the option of QE. There are significant rate cuts that they can deliver if we need them. I do think that an intra-meeting cut, would require financial systemic problems looming, which really we can't see much sign of. So the aggressive response would be a 50 basis point cut in September, another one in November. Certainly that is not our current scenario, but I think it's reassuring to know that they do have space to cut aggressively if they need to.
And I think it's interesting, you look at, again, more idiosyncratic information. The National Federation of Independent Small Businesses, optimism there, the highest since February 2022. Seema, I like the way you put this. We're either facing an economic riptide or merely a ripple. Are you any further along in understanding the reverberations in the pool of angst?
Well, so we're in a really difficult time at the moment, I think, for analysts and everyone alike. And if we look at, of course, the two data prints from before the market sell-off. So the ISM manufacturing and the jobs report, they were particularly weak. And then last week, up to this point, we've actually had fairly reassuring data, which should have reduced some of the recession concerns. But I think there is a bit of an aftertaste from that market sell-off, where you have seen people say, well, look, there is maybe a deterioration in market sentiment. And if you have a deterioration in market sentiment, which leads to declining consumer sentiment, that certainly does raise the recession risk. The thing that we're really watching out for is, of course, the job market. If you see layoffs starting to build, well, typically that can become a self-reinforcing loop. And that very quickly does increase the recession risk. We don't see any signs of that right now, but watching out for, of course, the jobs report, but jobless claims, surveys, all of the information is really important to build up that picture.
Yourself and Callum Pickering can go to lunch then, because it's sort of the buyers of the Psalm rule and that narrative around that. Here's the thing, though, Seema. It is about whether real rates are repressive. Real rates are tight. That's the view coming from Paul Donovan over at UBS this morning. He said that's the biggest mistake of all. Real rates will have a real long variable lag, and that is our bigger risk in this back quarter in Q1 25.
Well, I think the real rates argument has been really important throughout. And actually, you know, just 2 months ago, when people were questioning whether or not the Fed would even cut rates this year, the argument was that if inflation is falling, then real rates are increasing, and therefore monetary policy is becoming more and more restricted. So the Fed has to act. I do think we have to put some weight on the real rate argument. In terms of the lags, you know, we know it's somewhere between 6 to 18 months, potentially longer. So there is some urgency, in which I do think that if you are starting to see those economic concerns build up, it's really about front loading those rate cuts, which is why, you know, if they do a 50 basis point cut in September, it doesn't necessarily mean that they would extend that pattern throughout 2025. It's more about bringing together all the force at the beginning so that they can ward off any further recession risk from building.
And that is about, I suppose, prevention rather than cure. You talk about markets, and the equity market specifically, Seema, vulnerable to but grinding higher. There's a real reluctance to test the lower bound. There seems to be this ever-ending desire to buy the dip, despite what was thrown at us last week. What are we up overnight? S&P 500 up again. Yesterday we were up 1.6%. NASDAQ was up 2.4%. There is a real resistance to believe in the downside.
I think that's true, but I also think that's because there's so much ambiguity about the economic outlook. You know, if you look at household balance sheets, if you look at corporate balance sheets, they're still very, very sturdy. So for economic weakness to then turn into recession is somewhat, I wouldn't say far-fetched, but I think that knowing that the Fed can step in size probably does actually reduce that recession risk probability. And certainly for us, we do think that the market is going to be very volatile as the market weighs up every single bit of economic data, which comes out not just for the next month, but actually also for the next couple of months, that you do continue to test up and down. But I think overall, you know, assuming that we do avoid a recession, then actually earnings growth should continue, and that should lay a path for equity markets to continue to rise, albeit, of course, nothing like the gains that we've seen in the first half of this year.
Maybe I'm just a little bit too late to buy that dip. Seema, thank you very much. Good to have you with me this morning. Let's see what the CPI numbers are a little bit later today. That will ultimately define the risk narrative for the rest of the week. Seema Shah of Principal Asset Management. Other stories trending on your Bloomberg terminal this morning. This is what we've got for you. Japan is set for a new leader as the Prime Minister Kishida decides not to run for a second term. The leader of the long-ruling Liberal Democrat Party said he would devote himself to supporting the new leader, who is likely to win the leadership race expected in late September. Elliott escalates its push for sweeping changes at Southwest Airlines. The activist investor nominates 10 candidates, including 3 former airline chief executives, to Southwest's board. Traders are bringing forward the bets on the pace of the Bank of England's interest rate cuts. That's after the UK inflation numbers increased less than the economists had estimated and the Bank of England expected, with the CPI rising 2.2% in July rather than 2.3%. In actual fact, we've had some pretty encouraging news flow around currencies this morning. So the CPI in the UK comes in that little bit lower. 2 Bank of England rate cuts are now priced in. The pound is down by an eighth of 1%, so 2 cuts for 2024. Services are the lowest in 2 years in the UK. For the Kiwi, and this is important, the central bank governor there, Orr, talked about, says that 50 basis point cut was considered, and you can see the Kiwi against the dollar there tanking by over 1%. And the yen investors, be wary. 147.10, where the dollar's up an eighth of 1%. But retail investors have locked and loaded their bullish yen wagers to nearly a record level, up another 22%. So retail like the long position in yen. Currencies are definitely at ground zero for volatility. Coming up, Alphabet getting a hit in the pre-market trade as the DOJ is said to be considering a rare bid to break up Google. We bring you the scoop right here on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Next week, Balance of Power is live in Chicago for the Democratic National Convention.
So we've got a race here, and the sprint begins.
We'll bring you breaking developments.
Vice President Kamala Harris closing the gap with Donald Trump.
And informative analysis, all leading up to special coverage Thursday evening, including Vice President Harris's acceptance speech as the Democratic nominee for president.
As president, I will show Donald Trump what real leadership looks like.
Tune in all next week on Bloomberg Television.
Hey, it's Bloomberg Brief. I'm Menace Crenny in New York. Shares of Alphabet are falling as the U.S. Justice Department is said to be considering a rare bid to break up Google. That's after a court ruling found the tech giant monopolized the online search market. Now, if the ruling is pushed through, it would be Washington's first push to dismantle a company for illegal monopolization since the unsuccessful efforts to break up Microsoft. That was 2 decades ago. Tom McKenzie is tracking the tech stories as ever. Tom, look, this is about a tectonic shift. The ground is going to shift under Alphabet. It's now just a question of the scale of the shift and the reparations and the impact on the business. So talk me through the level of threat from the DOJ, because just a week ago you and I were saying, oh, we've had the ruling, but we didn't see any sign of a breakup threat in the first read.
Yeah, Manus, look, you sum it up perfectly there. We knew leading up to this Bloomberg scoop that this could be an option for the DOJ. Now we're reporting, our team on the ground, of course, with this scoop, that it is one of the options. They haven't decided which option, but we know this is in the mix. They are prepared to press the button on a breakup of Google. What that could look like then is the divestment of Chrome, the web browser, and the divestment of the operating system Android, as well as their advertising platform, Google Ads. This is a potential scenario that the DOJ are now considering. On the back of this monumental ruling, don't forget this historic ruling that we talked about last week, that came through from the judge who said, yes, Google is a monopoly, and part of the reason it's a monopoly is because it's been paying Apple and Samsung these exclusive contracts, these exclusive deals to host the web browsers on those smartphones, to the tune of about $26 billion, by the way, for those smartphone makers. So this is one of the consequences. There are less severe options the DOJ could go for. Part of this is interesting as well because it's also forward-looking. It's also considering Google's role, Android's role, and Google's role in terms of AI. And one of the solutions could be to get them to share more data with their competitors, which could reduce the risk of them being a monopoly when it comes to AI. But certainly ending these exclusive contracts seems very likely in terms of one option for the DOJ. But they are also considering pressing that button on a breakup.
Well, let's just stay with the tech theme because Norges Bank, they reported their results yesterday. This is one of the world's largest sovereign wealth funds. 8.6% return. Tech was the alpha. But I'm just wondering, that part of this story is that they're trimming some of their big positions in tech in Meta and ASML and also in Nova. Is that because they've had an exceptional run? Have they told us any more details on it yet?
We don't know the details yet. We're going to be speaking to the CEO in a little over 1 hour's time. So we'll see what Tangen has to say about the rationale for that and whether this is good timing in terms of taking profit on some of these big tech names. As you say, stateside, Meta was one of the standout names in terms of trimming their holdings in that business. Novo Nordisk here in Europe, of course, consequential around the obesity drug business. They've trimmed their holdings there. And then ASML, in terms of the maker of lithography machines, also trimming the holdings there. Interestingly, Manus, they've increased their holdings in terms of some of the energy companies like BP and Exxon.
Yeah, I mean, that was one of the very interesting pieces. Of course, we're going to have an opportunity to speak to the man himself a little bit later on some of the motivation. Tom, great work on the story. And, of course, big shout-out to the print team on the Alphabet exclusive, breaking that news. Tom McKenzie in London. A different story. This time, the confectionery sector. Mars is expected to announce a deal to close a $30 billion worth of snack maker Calanova later today. The Wall Street Journal is reporting that the privately held company is expected to pay $83.50, all in cash. Let's unwrap the details and the motivation. Dasha Afanasieva joins me now. Dasha, I mean, it's a really surreal time to see somebody like Mars pay this amount of money in the consumer space for snacks that we're all supposed to be turning away from and injecting ourselves with Ozempic.
Absolutely. So for Mars, the upside is that they're diversifying away from cocoa-based snacks, which is a big chunk of its portfolio. They also have pet food, and they have chewing gum, and they're also spreading. They've got geographic spread by acquiring these non-chocolate snacks like Cheez-Its and Pop-Tarts and Pringles. But as you said, paying a 30+% premium on a company that is at the heart of, consumers turning away from it, certainly which is still, I think, about 50% of its revenue, is kind of counterintuitive. I guess Mars has decided that the downside from that has already been priced in. And there is an argument to say that an asset like that, with the increased scrutiny on junk food makers because of their sugar and salt content, you could argue that an asset like that is better in private hands. But I'm not sure if a public company would have gotten away with such a premium at such an uncertain time.
Well, the two of them together, Mars and Calanova, it's going to be, what, 12% of the snacking industry, the candy industry. That's according to Nielsen. Dasha, thank you very much. Let's keep an eye on that space. Bloomberg's Dasha Afanasieva on the deal flow. Coming up, shares of UBS rally after the lender delivers a handsome beat.
We set our plan that we believe we need to get to mid-teens pre-tax profit margins in the next two or 3 years, and then from there onwards we will look at ways to improve it further.
That's coming up next. Context matters every day on Bloomberg.
The top names in business are on Bloomberg.
The challenge for us now is not very much on the product, it's on the ramp-up of the production system.
We turned the industry down to almost zero during the pandemic. And what we're trying to do now is turn it all the way back on. And that's hard. We lost not only people during the pandemic, we lost a tremendous amount of experience.
A lot of skilled people have left the industry. We have to hire new people. The supply chain has to hire new resources and train the people, educate them.
And because those roles are filled now not by a 58-year-old, but perhaps by a 28-year-old, there's a lot we have to do in terms of not only adding capacity, but capability to meet the ramp that we all are embarked upon.
We have thousands of suppliers, and when you have just a couple of them, few of them that are late on the ramp-up, well, that's slowing down everybody, and that's what we've been facing earlier this year.
Nobody covers business like Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Asia continues to be a pretty good secular driver of growth for our business. U.S., we are, I'm glad we are making good progress with some initiatives to make the IB and wealth management working closer together. This has helped our transaction activities in wealth management. We set our plan that we believe we need to get to mid-teens pre-tax profit margins in the next two or 3 years.
The UBS CEO Sergio Motti there on the efforts to return capital to shareholders, getting a boost after a profit beat in the second quarter. Francine Lacroix is on the ground in Zurich for us. Francine, good to see you this morning. I mean, he's delivered robustly everywhere, double the estimate on profits. And I think doubling down on this buyback is one of the big sort of alphas in these numbers this morning.
Yeah, absolutely. First of all, Manus, you're missed in Zurich every time I cover UBS. I kind of think, you know, there's a cranny standard that I need to make sure I uphold at every time. But look, Sergio Motti was in good form today. He beat on many things when he gave us a timeline also of acquiring and putting together Credit Suisse. He's sticking to that. And when you speak to a lot of analysts and some of the bankers, of course, that cover UBS, they say, look, whatever they can do internally, they're on top of it. They're streamlining, there's job losses, they're cost cutting, they're able also to attract inflows in wealth. And a lot of the focus, of course, will be on wealth management with Iqbal Khan going to the US, to Asia, and with a new person in charge of the US where they want to push through. So it seemed like at the moment they're firing on all cylinders, but they're also worried and preparing for possible capital requirements.
I watched the conversation, and I saw where you kicked into gear on the regulatory front, and this is where he will do a battle royal with the regulators in terms of the extra capital that the regulators and the government want in Switzerland versus the shareholders. And he's certainly squaring up to them publicly, isn't he?
Yeah, he is. You're right. I love the fact that you use the word battle royale, because it is a little bit like that. But as soon as we heard from policymakers of what they wanted to do and actually force banks, i.e. UBS here in Switzerland, to hold extra capital, he went all guns blazing saying, look, this will hurt this and it will impede what UBS can do in the future. And now he actually took a bit of a turn and says, look, it's just too soon to speculate. So what he did tell us, there was nothing on capital requirements or on what the Swiss regulators want them to do in the earnings report. When I asked him a couple of times in the interview afterwards, he said it's too soon to speculate. He does not expect it to change any dividend or shareholder buyback plans, but he did give us a little bit of a timeline that he's expecting to know more by the end of the year, and that's when we'll have probably a broad figure, and we'll see whether it changes actually the business plan for UBS going forward.
Look, briefly, this is the CEO that you and I know very well. He comes from a markets background. What was his take on the past 10 days, briefly?
Yeah, look, he was very good on that. He said, first of all, that he does not expect the Fed to cut as much as the market's expected to. And he says, given the volatility, it'll just show who's best. We know, Manis, that he doesn't shy away from race or to how, to showing the world what UBS can prove and achieve. And I think he says this is the right time to be close to customers. It showed us that there's going to be even more volatility. He mentioned geopolitics. He mentioned this U.S. election, and they're ready for the fight.
They're ready for the fight. Fragility in markets. That's why you depend on your wealth manager. Francine, great work. Good to see you in Zurich there. I miss it. Regards to everybody in the office. Francine Lacroix on the ground in Zurich, tracking the UBS story. Snapshot of the bond markets. Flat on 10s, 384. We're counting down to CPI. Will it be plus 0.2%? Better news flow in the UK on inflation. Yields dropped 2 basis points.
Institutions you've been very philanthropic with is your alma mater, Harvard. But recently you've been very public about your criticism of the way Harvard handled the events of October 7th and their aftermath. Could you talk about that now?
The first reaction of a group of 34 Harvard student clubs on the morning after October 7th was to put out a statement saying that Israel was 100% responsible for the acts of Hamas. And my view on that was, that's ridiculous. You can come out and say, look, I'm very unhappy about Israel's treatment of Palestinians in the West Bank, or you can say, we can talk about the Gaza Strip, but you can't support terrorists, and particularly terrorists that rape and pillage and murder and burn and take hostages. Well, I got actually a text from a CEO in my industry. He's like, Bill, you know the people at Harvard. I'd like to know who the students are behind these clubs so I make sure I don't inadvertently hire them. And so I tweeted out that sort of made that point and caused a bit of a firestorm, and I got a lot of pushback. Oh, why are you picking on students? And I said, look, you can't hide behind a corporate entity if you're going to support terrorism.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Manus Craney. Let's set your agenda. Cementing the Fed cut. Markets count down to CPI as producer prices deliver another brick in the disinflation wall. UBS produces a punchy beat on profits and progress with integration. Amati doubles down on a $1 billion buyback for 2024. And makeup and breakup. Mars inches closer to a deal to buy Kellanova as the DOJ mulls breaking up Google following an antitrust win. State of play off markets as we're counting down to CPI. That will define the risk narrative ahead of the retail sales tomorrow. S&P 500 still inching into the green there, just about. Four-day rally, the best four-day rally that we've had on the S&P 500 this year. Bank of America's clients in the survey are net buyers for the first time in over a month. Flat is where we are in 10-year government. By the way, keep an eye on Alphabet at the bottom. I'm surprised. Yesterday it closed up on the back of the Bloomberg exclusive that the DOJ is mulling a breakup of Google. The stock traded up into the close yesterday. We're now down 1%. That is Europe. What will the street do as they come in? Iron ore is also under a bit of pressure this morning. You've got one of the biggest producers of steel warning, buckle up. The downturns are coming, similar to 2008 and 2015. There's a severe winter on the way in China. That will have a reverberation across the world. Maybe that's what's causing moments of pause in the house of JP Morgan and Goldman Sachs on their recessionometer, incrementally going higher to 41% at Goldman and 31% at JP Morgan. We're less than 3 hours away from that. Sorry, less than 3 hours. I got the time right. It's an early time, 5:30 in the morning, 3 hours to go until the CPI hits the tape. Mike McKee is with me around the desk. We got him up early. We brought him in early. Now, the last month was a surprise. What should we really focus on in this set of CPI today, Mike?
We're going to focus on progress. Is there incremental progress, or does something go the other way that would cause Wall Street to start to worry that maybe the Fed is behind the curve, either letting inflation go out of control or inflation's coming down so fast that it signals any kind of weakness in the economy? But as you can see, we are looking for a slight rise in both the headline and the core on a month-over-month basis because we had a big surprise on the downside last time. Doesn't make a whole lot of difference year over year because essentially we're into a base effect situation where inflation was higher last year. So the move isn't going to be as big. But as long as it doesn't suggest we're going the wrong way, then Wall Street should be happy.
And the PPI yesterday, the component parts of that PPI yesterday that play into the PCE, I know that we've talked about this over the past 24 hours, but again, that builds on the narrative on why the bond market rallied, why the market is incrementally moving towards a bigger rate cut in September.
Well, we're looking at things that had not moved a lot, like housing. And while it's not as big a deal in PPI and CPI, it is the whole ballgame. It's like 30%. And we're finally seeing some declines in housing prices in the way they measure it, which is kind of a controversial method, shall we say. But as you can see, housing prices are starting to go down. And if that continues, then that's going to put some real downward pressure on the overall CPI and make the numbers look better.
We're also going to get retail sales tomorrow, and that, you know, we've had various sort of canaries in the consumer coal mine becoming more judicious at Home Depot, Heineken finding it tougher here in the American markets, etc. The thinking on retail sales is what? Remain reasonably robust?
I don't think people would use the word robust, but remain still going up, put it that way. The feeling is that maybe people have started to cut back, and that's a concern. So it will be very interesting tomorrow to see retail sales. Now, retail sales are primarily goods sold. So we'll see if there is a cutback by consumers. But following the jobs report and some of the other disappointing numbers that we've had, there's a narrative growing that maybe the economy has slowed too much, or we're getting into a stagflation situation. So if we had a bad CPI report today and a bad number tomorrow in retail sales, then you'd start to hear that word again, stagflation. Too early to say that's happening, but it would start going around Wall Street. So we got to keep an eye on both of those things and remember that Jay Powell said they're going to look at the totality of the data when it comes to their September meeting.
It's interesting, Apollo's Torsten Slok, his morning note this morning talks about credit card utilization still significantly below 2019 levels. This is interesting, especially for the baby boomers. I'm not quite in the baby boomer camp just yet. Let's just have a quick reflection. This is what Paul Donovan has put out this morning. He's talking about the U.S. Consumer price inflation, forcing economists to become used car salespeople and real estate fantasists. Part of the disinflationary trend comes from used cars, which most U.S. households will not buy this year, and fictional owners' equivalent rent, which no one pays. I mean, this is rather scathing of Paul, but it's sort of classic Paul. And he says the bottom line is you've got tight real rates. That's the bigger error rather than not cutting sooner.
Well, the question for the Fed is not just what does the CPI tell us, but how they react to it and how they react to the components. Now, obviously, Paul has a point about owner's equivalent rent in particular. However, owner's equivalent rent was a reason that inflation went up. So while it may be mismeasured or measured badly, it works on both sides. So the Fed has to take that into account. And also, they look at the PCE inflation numbers, which give a much smaller weight to housing than CPI. But it is something to keep an eye on. But there are definitely two camps on Wall Street, one saying Fed needs to do more, and or at least stay higher for longer, and the other saying the Fed is behind the curve. And there's no way to know, really, until we get past the curve. But at this point, the Fed seems relatively confident that it is not.
Indeed. And Bostic is very reluctant, to pull the trigger yet.
Bostic and Mickey Bowman in this past week saying, we're not ready yet.
No, they're not there yet. They are reluctant. Mike, thank you very much, Mike McKee. It is 3 hours away, and Mike will break that news with the surveillance team live for you. My guest now is Mark Malik, CIO of Siebert. Mark, good to have you with us. Look, so much sentiment is hanging on every piece of economic data. The PPI laid the table, the CPI is today. The Fed has the wind at their back, but it's still very, very hard to call this market at the moment. For you, what's important today?
Well, clearly, we're going to be focusing on the components of the CPI, as Mike just pointed out. We're going to be looking at services, which has been the problem. We're going to zero in on that controversial rents number that has been bubbling down. Although very slowly, we'd like to see it continue to come down. That could certainly be a rainmaker in the wrong direction if it comes in slightly higher. We're going to be focusing on that. But looking forward to the markets, we too are looking at those sort of recession indicators as well to really set the tone for the market going forward.
And yet, if I look at some of the information that I have in the past 24 hours, the small business survey, optimism is up there. Yes, they're being squeezed and they've got issues. And some people are saying, look at that data rather than perhaps anachronistic data that's not fit for purpose. Small businesses are the lifeblood of this economy in many ways. And if they're still optimistic, we shouldn't be so quick to hurl the recession brick.
Sure, agree 100%. They're going to be watching they're going to be watching interest rates. Small businesses are relatively sensitive to interest rates. But at Siebert, what we like to look at now are these earlier indicators, as you suggested. We're looking at consumer confidence types of numbers, which might be more leading indicators of consumption. Consumption, as you know, makes up 66% of GDP. So we're looking at things like consumer confidence, We're going to be watching this Friday's UMich number. We have consumer confidence coming out next week or in a couple weeks. We're going to be watching that as well.
Okay.
These are sort of more leading indicators for how comfortable consumers are.
Tell me then, the S&P's had its best four-day rally of 2024. Is that misguided confidence?
We're kind of positive on the market. I mean, this recent pullback, some of the growth sectors that everybody loves and we still like as well, those have become, let's call it, more valuable with this recent pullback. They still haven't come back all the way. The growth story for some of these companies hasn't changed. They're just a little bit more on sale at this point. So it sort of makes sense for people to be nibbling back in at the market. And assuming that these upcoming numbers, today's number, the retail sales number coming out, and assuming these numbers support that thesis, we think that there's a little bit of room here still.
Look, we have one headline today, Mars bidding for Kellanova, the DOJ making a play, a Bloomberg scoop, to break up Alphabet. On the M&A front, it's a very interesting move by Mars at this moment in time. There's a couple of things that people have said to me will create floors in this market. One of it is M&A and the other is buybacks. How important are those facets to you?
Well, they are certainly important, and they bring to the front of the discussion the presidential election. We're all watching that very, very closely. We don't have a lot of let's say, call it policy out of the Democratic side yet, although, earlier speculation would assume that, a Democratic win would certainly, put some clouds over the M&A market versus a Republican win. So I think a lot of us are looking very closely at that in the M&A market, how that might impact what a future DOJ might look like, with Alphabet and this another proposed merger that we just discussed before. So that's going to become the front of the discussion when we're talking certainly about mergers and the DOJ and the FTC and all that stuff.
Tell me this, we haven't had a sit-down interview yet with Kamala Harris. What do you want to hear from her? What do you think the market wants to hear from the ticket?
Well, I think we'd like to hear a little bit, more moderation, some more business-friendly talk, some actual solid policies. The only thing we really have at this point is sort of rhetoric, which seems to be mimicking the Republicans' platform. So I think the market certainly would like to hear her take on her approach toward business, what her thoughts are on corporate taxes, and things like that. Those will have direct effects on the market.
Okay, well, the devil is in the detail, as they say, isn't it, Mark? Let's see what comes out of those initial sit-downs, if there are multiples or just one. That is Seabert's Mark Malik on the markets. Coming up, UBS getting a boost after delivering better than expected profits. More on the story. The stock is bid this morning, and Monty doubles down on his buyback. This is Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Why should I want to invest in the pharmaceutical industry? Is it going to continue to grow as it did last year? And what about your own company? Do you think it's going to have good growth prospects over the next couple of years?
I think the reason to invest in the sector is the science. I mean, when you look again, if I go back into the history, for most of the last century, we were only giving people pills and small molecule drugs. Then we discovered that we had this whole world of biologics, and we could treat diseases with biologicals. More recently, we've discovered that we can reprogram your cells, we can edit the genome, we can use these RNA therapeutics to completely transform areas of medicine. Those technology areas are at their very nascent stage, and what we're going to find is they're going to open up whole new areas of growth from our business standpoint and a human health impact standpoint. We hope that as we work in our areas like cell therapy and RNA therapeutics, we will also be able to climb to a whole other level of market cap over time.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Asia continues to be a pretty good secular driver of growth for our business. The U.S., we are, I'm glad we are making good progress with some initiatives to make the IB and wealth management working closer together. This has helped our transaction activities in wealth management. We set our plan that we believe we need to get to mid-teens pre-tax profit margins in the next two or 3 years.
UBS, the stock is rising this morning after beating analyst profit estimates, bolstering the CEO Sergio Motti's plans to return $1 billion through 2024 in buybacks. Alessandro Speziali joins me now from Zurich. Alessandro, thanks for taking the time. If we look at the drivers of the beat in this quarter, obviously wealth management is incredibly important. It's about the inflows and the activity of clients, isn't it?
Yes, and it was a solid quarter. It was $27 billion of new net assets, which was on par with what UBS did in the previous quarter. So it shows that there is a solid trend of new assets coming in. And of course, then the surprise maybe here was also the good results of investment banking. Did almost $500 million of profits there because of higher transaction activity, especially from institutional investors. That's also a good sign going forward, especially given that UBS has some regulatory headwinds, especially here in Switzerland. Regulators want to impose more charges for UBS's foreign units. Wants UBS to retain more capital against those units. We'll know exactly how much in the first half of next year, but Motti said that there is probably no risk to the capital distribution plans of his bank.
And herein lies the point. We were chatting to Francine a little bit earlier. I just wonder how this landscape looks. It is a battle. It's a battle of wills and regulation, really, between Motti and Kelleher in terms of the capital that's required for now the biggest bank in Switzerland, one of the biggest in the world, systemically important banks in the world, versus the shareholders. And the shareholders, if we're to close the price-to-book valuation to the U.S. banks here on the street, it is going to be about the amount of capital that they hold and the distribution that they make.
Absolutely. And Motti and UBS have made it very clear that they want to compete against their Wall Street peers. Those are really the banks that they see themselves as competing around all over the world. It's been quite surprising here in Switzerland because UBS went from being the savior that came in and swooped in and rescued Credit Suisse and stopped what could have been a broader banking crisis. And then there has been quite heated words, both from the government and from UBS on these capital requirements. UBS and Motti, Kelleher have both been pretty vocal that this would be a good idea, that UBS is not a problem, but has been and will continue to be part of the solution. We'll see how it plays out. The rhetoric was a bit toned down today. So, UBS has made its point clear, and we'll see how the regulatory landscape will shape up in the next few months.
Having spent time with Motti when he went through the first radical shakeup of UBS 10 years ago, and over that period of time we met several times, he's a CEO that knows how to reduce and cut the non-core legacy assets aggressively and quickly, and I think that's part of this story. Non-core risk-weighted assets down by 42% in the second quarter. He's moving with haste.
Yes, the implementation of the Credit Suisse mergers is progressing apace. UBS has shown that it's keeping its targets in implementing. I think it was 8 billion reducing assets in the second quarter. Cost reduction targets have been increased to 13 billion overall, and it's on track there too. It's on track of getting back to the profitability levels that it had before the merger. So yes, there's still a lot of discipline on the merger, and at the same time, I look at what's going to bring profits for UBS in the future. There has been recently a restructuring of the wealth management. Around now 2 co-global heads, Rob Karofsky in the US and Iqbal Khan in Asia, and of course that's also probably shaping up the battle to succeed Motti in a few years' time.
Alessandro, thank you very much for being with us this morning. Alessandro Specialida in Zurich. Let's pivot to technology space. Different story. Alphabet, the stock this morning falling as Bloomberg delivers the scoop. We learned that the DOJ is mulling a rare bid to break up Google. Now that's after a court ruling that found the tech giant monopolized the online search market. If the bid is pushed through, it would be Washington's first push to dismantle a company for illegal monopolization since the unsuccessful efforts to do that 2 decades ago to Microsoft. Tom, McKenzie is tracking this story. Tom, it's a Bloomberg scoop. How big is the threat? How real is the threat on the level of reparations of a breakup? Is breakup top of the agenda?
Breakup is being considered, and it would be the nuclear option for the DOJ. And a breakup would include, we would expect, and this is our reporting, the divestment of, for example, the Chrome browser, but arguably more importantly, Android OS, the operating system used in about 2.5 billion smartphones and devices around the world, 2.5 billion, but also the Google Ads part of the business as well. That's what a divestment could look like. That is why pre-market you're seeing this drop of a little over 1%, as you say, for Alphabet on the back of this. They could look at less severe options, though, the DOJ, and amongst the mix there would include ending these exclusive contracts that Google has had with the likes of Apple and Samsung, essentially to pay them, to compel them to have their web browsers set as the default. And in that case, and that context, this was where Google was found to be this monopoly. It seems very likely those contracts will be ended. It also seems pretty likely that the DOJ will pressure Google to share more of its data. But it's looking ahead as well in terms of how Apple positions, Google positions, I should say, around AI and how it can use its data dominance, and concerns about the fact that it could be a monopoly in that space as well. So those are two of the lesser severe options, but top of the list in terms of the most severe, in terms of consequences, would be the divestment, and we know now that is part of the mix for the DOJ as they weigh up their next steps.
Well, they certainly have, I mean, these are tectonic shifts. It's just a question of the scale of the shift and how that settles. Let's have a quick chat on Norges Bank. They reported the results. I think the more interesting thing is about the divestments that they've done, or the trimming, I should say, in some of their allocations to Meta, ASML, along with Novo. So it's interesting on the tech side, isn't it?
Yeah, look, there's some nuance here on the tech side because they've trimmed those holdings, as you say, in Meta. But amongst their top 3 holdings, in fact, their top 3 holdings include Apple and Microsoft and NVIDIA. NVIDIA, of course, reporting at the end of this month. So they're still in on tech. They're still exposed to tech. Of course, this sovereign wealth fund invests in about 8,800 companies globally. They're essentially invested in most publicly listed companies. But the tech story is nuanced. And interestingly, we touched on this before, they've also increased their holdings. As they trimmed on Meta and Novo Nordisk and ASML, they've increased around the likes of BP and Shell, where they've become a little bit more activist on some of those oil companies.
Yeah, it's certainly an interesting pivot. Tom, thank you very much. Tom McKenzie there on the very latest with the tech stories. We're going to catch up with the Norges Bank Investment Management CEO, Nikolai Tangen. That is at 11:30 a.m. UK time. We can begin to understand some of the trimming in tech. Coming up, setting up your trading day ahead of the CPI. Fed Speak is on deck. Context matters every day from New York. Good morning.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Your day ahead looks a little bit like this. The main event, CPI, 8:30 a.m. Eastern Time. That will define the trajectory for the rate cuts from the Fed. Then we're going to hear actually from the St. Louis Fed President Alberto Mussolini. That's at 9 a.m. The Philly Fed President Patrick Harker hits the tape at 1 p.m. And you're all waiting for the 13F filings for the second quarter. They are due today. So let's see what the positioning in tech is. Let me just show you what's going on with the S&P 500. We had a little bit more of a spirited start just over an hour ago when we kicked in, but this is the best four-day run that you've had on the S&P 500 so for 2024. The question is, can that endure? We're counting down to CPI. We'll break it all for you on Bloomberg Surveillance. Good morning from New York.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
I'm not really concerned at all about inflation staying too high.
You still do have inflation that's above target.
Inflation expectations are slowing down with the economy.
You see slower growth, which is a necessity to cool inflation.
I don't see this as actual weakness.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
We're already back to Goldilocks. That was short. Welcome back. Good morning. This is Bloomberg Surveillance ahead of a key inflation reading in the U.S. The Sage said as follows. We get CPI in about 2.5 hours. Traders are heavily positioned for it to support the soft landing thesis. The S&P 500 has just had its biggest four-day rally since November. In the past week, Apple is up almost 6%. NVIDIA is up 17%. AMD is up 10%. Meta, 8%. Danny, are we back to complacency?
Well, it certainly feels like everything is turning up dovish. This huge, powerful rally that maybe just gets another leg overnight into today's session, with CPI in the UK being soft, with the RBNZ cutting too. The one good thing maybe about yesterday's powerful rally, even though it might have front-run CPI, is that it happened when the yen was also appreciating. So maybe this dangerous cross-asset link has been broken. So normalcy for now, whether it holds is a different question.
Well, there's this real issue here of whether we've essentially priced in a soft landing globally, whether we're getting the idea of a dollar that's softening, weakening versus currency globally, simply because the consumer can keep upholding spending even as inflation normalizes and we get some price stability. And Marie, we've been talking a lot about consumer appetite, their ability to spend. We've been talking to a whole host of travel executives. Today, we've got Tony Capuano, the CEO of Marriott, on the same topic.
Yeah, really the question is how resilient is the U.S. consumer and how bifurcated it is. And what Tony was talking about, the CEO of Marriott, and their earnings, they say they have real resilience on the upper end. There's still this appetite on the luxury end to travel, while Home Depot is talking about this deferral mindset. Potentially these consumers have the money to spend, but they're waiting. They want to see where interest rates go before they go out and make those big purchases. So we know that CPI is going to matter a lot to the Fed today. Raphael Bostic said yesterday they need just a little bit more data, but politically it matters. This is the first of 3 prints we're going to get for the U.S. election, and inflation has been top of mind of voters.
So this is really one of the big conundrums for the Federal Reserve. The economy looks like it's okay. Consumers have plenty of money to spend as long as they are wealthy enough to have fat paychecks and fat bank accounts that have been bolstered by higher rates as they are. How does the Fed take this at a time where 2-year yields, Danny, have fallen by some 30 basis points over the past month in August just alone? You look at the euro, it is the strongest going back to the beginning of January versus the dollar, all hinging on a Fed now expected to cut rates by more than 100 basis points before year end.
And just on that alone, just on the market moves, the Fed looks so offsides, which will be fascinating to hear if we do get a softer print, if they come more in line with the market's thinking. To your point, Anne-Marie, Bostic yesterday, we want to be absolutely sure. I'm willing to wait, it's coming. I want to see a little bit more data. We need to make sure the trend is real. That is not a Fed debating between 25 and 50 basis points. That is a Fed debating whether to cut it all.
Well, Stephen Stanley overnight was talking about how actually Santander has a 0.3% increase in their model and how that can be completely different for the Fed. And while everyone is still focused on this 25 or 50 on September right now, there are still people in the Raphael Bostic camp that are talking about, well, is it September, November, or December?
And we have someone who's going to be coming on the show and saying the real risk is reacceleration of inflation, not the potential risk of the consumer falling off a cliff. We've got a great show coming up. Marvin Lowe starting us off of State Street on why the Fed can remain patient, sort of to the point that you were just talking about, Anne-Marie. Mike Shepard of Bloomberg, as the DOJ reportedly considers a bid to break up Google. And don't miss this, Justin Dercole of ISO MTS, on why he sees signs of a re-acceleration in inflation. If you want the Fed to cut rates by more than 100 basis points, he thinks maybe you're looking at the wrong stuff. We begin with our top story. Stocks on pause awaiting U.S. CPI data at 8:30 Eastern. Marvin Lowe of State Street writing this. Every data point is live, and policy expectations will be volatile around each of these data points. By our estimation, there is no reason for them to think about 50 basis points in September, nor is there any reason to rush into a November cut. Marvin, swimming against the tide, you're joining us right now. We're back to Goldilocks. Everyone is pricing in more than 100 basis points of rate cuts. Why are you pushing against that?
You know what? We're not really seeing the degree of hysteria that the market had thought we were in, a week and a half ago. To get to 4 to 5 cuts, which is how the market moved in a very, very short order, you've got to see a recession that's very, very clear to both you and the Fed. And we just don't see that data. And, certainly the volatility in the market was scary, but it was isolated to, parts that were overextended, and we knew that they were overextended.
That said, we're seeing some really clear signs that consumers, particularly those who are not at the very upper echelons of income, are struggling. They're starting to push back. You hear this in the commentary from pretty much every single company. No recession calls for the most part, not very many anyway, but definitely weakening. How do you sort of discount the idea that the Fed has an opening to really get ahead of some sort of more material slowdown because inflation is coming off the boil so significantly?
Yeah, I mean, that's the eye of the needle for sure. There are stresses in the economy. We've seen those stresses really get more acute for certain income groups over the last couple of quarters. The restrictive aspect of policy is working. Transmission is different this time. We still have a lot of wealth. Everything that we talk about in terms of Goldilocks and in terms of the rebound, if you will, in a lot of these stocks is creating wealth for certain parts of the economy. Having said that, it's not widespread. So that's what really gets me comfortable that the Fed will start the process. But again, the market is ahead of itself if it thinks that it needs to really accelerate that view.
When we say the market's ahead of ourselves, Marvin, we have to just be talking about bonds at this moment because stocks did a big old rally back to nearly where they were at the start of the sell-off. JP Morgan points out that overall the market sees a third of a chance that we will get a recession, while equities are just pricing in a 1 in 5 chance. So if bonds are wrong, Marvin, are stocks right?
You know what? I think that the equity investors took the opportunity to buy stocks that got cheap. There was a certain amount of momentum that was in the market. We took off some of that froth. Maybe we got a little bit over aggressive. But again, yesterday it was, a bit more widespread, but it was the same leaders that were driving, the rebound, if you will, and those become the easiest names to own when you're worried about growth slowing. This is quality growth that once again is the story that's driving a lot of these valuations.
So take me to this future, Marvin, where the Fed starts this normalization process. They start talking about it at Jackson Hole. The bond market, as you say, is already there and maybe past that. What is the reaction in the equity market? Is what you're describing a blueprint of what we should expect when that conversation begins?
I do think that the soft landing, which went by the wayside over the last couple of weeks, becomes part of the discussion again. I think we're going to see a moderating in inflation. PPI was a good start to it, but there were parts that made you think that it might not be as aggressive of a disinflationary trend going into the fall. That's all fine for equities, particularly companies that can demonstrate that they've got a moat that they could defend from an earnings perspective. The Fed will begin laying the brickwork that they're going to start normalizing rates, but they're in no rush. That's not necessarily bad for valuations. I think what we need to do is put intersections between liquidity, between the soft landing, and really between politics, whether it's geopolitics and or U.S. elections into the fall. So, I don't think that it's going to be completely smooth sailing going into the end of the year. Kind of having said that, risk is still somewhat supported in here. And, make sure you're buying the quality parts of that story that you like.
Marvin, what could upend your belief that we are headed to a soft landing? Is it a data point or is it something like you just mentioned, a geopolitical event?
You know what? I don't think we're going to get a data point that's going to change the story over the course of the next, let's say a few quarters. Whether or not all of the data moves back towards 2% as convincingly as the market expects it by the middle of next year, that's something that we could debate in a couple of quarters. I do think geopolitics are something that, in terms of how asset values are incorporating it, are telling different stories. I do think that Some of the geopolitical concerns made their way into the risk market yesterday, but they didn't really show on the equity side of things. So, people are picking, if you will, the best parts of the stories that they want to hear.
Do you think the market right now is underpricing what we are seeing in terms of geopolitically in the world?
Yeah, it's always hard to put a valuation number on what's going on. Again, I think the fact that rates could be showing some of those concerns, but other risk assets don't, make me think that there are certain parts that are underpricing it.
Just to sort of put this all together, you started by saying that the Fed really didn't have to cut so aggressively. You didn't really see a case for a 50 basis point rate cut. You talk about how there are some opportunities to buy the dips. You wrote in your notes, don't fight the rally in duration, because it's a pretty powerful one. Do you think that if the Fed does cut rates more aggressively, that could actually disrupt the soft landing that we're seeing right now?
Yeah, for sure. Why? And you and I have discussed this, and we've discussed this on the show. Why you cut rates are really, really important. If the Fed starts to think that there's 50 basis points are needed because the economy is much weaker than maybe some of the data that I'm looking at, you have to be concerned with that. Kind of having said that, if it's based on normalization, if it's simply based on disinflation getting more aggressive, the market can interpret that well. And, I guess that's the bid in the offer based on kind of what we do. Having said that, we still don't think that they need to rush. And everything that we've heard from the Fed is that they are still patient around that.
Marvin, I want to get a better idea from you what that feedback loop looks like if the Fed does cut aggressively, in which you say could lead to the end of that soft landing. Is it people expecting a recession, so there is a recession? Is it corporates pulling back? What actually is the mechanism for that playing out?
Yeah, I think the labor market is still front and center. That's kind of what really drives whether people feel good or not. Are they sitting? Are we still able to talk? And I'm still at my same seat at State Street. That's an important part of the discussion. If we do start to get confirmation that the weaker prints that we saw on the labor market last month leads to potential job losses, larger job losses, I think that ultimately changes the psyche. Companies will adjust quickly. We heard from the small business survey yesterday, and there wasn't that concern. So, again, it's packaged well, but yes, it's going to be labor market. It's going to be companies that are responding to a significantly weaker labor market. Neither of those are within the data prints that we're looking at right now.
Marvin Lowe, always a pleasure to have you on. Marvin Lowe of State Street, thank you so much for starting us off today. It really is sort of the key question of where the balance of risks is. And frankly, Danny, we get pretty aggressive views on both sides, with some people are thinking at you, Neil, bounding the table and basically saying, we need to cut right now, and other people saying that would be the error, premature cutting.
Right, especially when you look, as Marvin mentioned, small business confidence at a 2-year high, Atlanta GDP Now tracker at 2.9%, payrolls are still above 100,000. Economists, for the most part, even though they've had a recent patchy history about predicting these things, see recession odds at about 30%. So you just look at that list and say, how could you get aggressive cuts? Maybe the way you get cuts is something, again, like the RBNZ that said, it's just low risk to cut right now, and it's an easy decision to do.
I have to say, Anne-Marie, I don't understand this market, though. I don't understand the response. Think about Home Depot yesterday, right? Think about what they were talking about in terms of a consumer pulling back. Those shares, which were down some 5% early in the market, end of the day up almost 1.25%.
Well, because what Home Depot is saying that they're deferring, these consumers are deferring. They will, once the Fed, to Neil Dutta's points, gets on with it and starts cutting interest rates. But it's difficult because you look across the landscape, and what seems so apparent when you look at what corporations are saying is that this bifurcation really exists. It's not just also bifurcation in the upper and the lower end. It's also the bifurcation throughout the globe. We have seen constantly that the U.S. consumer is the most resilient consumer out there. Where is the weakness coming from right now? That's coming from China.
Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hakes. Yahara.
Hi, Lisa. Japanese Prime Minister Fumio Kishida won't run for a second term as leader of the long-ruling Liberal Democratic Party in September. He said at a news conference he will devote himself to supporting the new leader selected through the presidential election. Kishida's successor will be Japan's third prime minister since the late Shinzo Abe stepped down in September 2020. Traders are bringing forward bets on the pace of the Bank of England's interest rate cuts. That's after UK inflation increased less than economists and the BOE expected, with CPI rising 2.2% in July rather than the 2.3%. Services inflation posted its lowest reading in more than 2 years. The BOE cut rates on August 1st for the first time since the pandemic. The bank meets again on September 19th. And shares of UBS are on the rise. The Swiss bank smashed profit expectations in the second quarter with strong client inflows and investment banking revenue, helping CEO Sergio Aramati's efforts to return capital to shareholders. The bank says it's on track for pre-merger levels of profitability just a year after completing the takeover of Credit Suisse.
I'm proud that we made very good progress in the integration, and so we significantly now reduced the risk of the integration itself. And we did that while staying close to clients, deliver very good financial results, which makes me comfortable that we are on a good way to deliver on our 2026 financial targets.
But despite Aramati's optimism, UBS says it also expects to book another $1.1 billion in integration-related expenses in the third quarter. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, keeping big tech in check.
Our free enterprise system is one where the best ideas are supposed to win. And we've historically seen that it's the disruptors and entrepreneurs that have been a key vector of innovation.
That's coming up next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Just coming off the biggest four-day rally in the stock market going back to last November. Welcome back. This is Bloomberg Surveillance. Right now, we are completely flat, 54.59, heading into CPI coming up in less than 3 hours' time. Meanwhile, we do see that ongoing dollar weakness as people take a look at just how much the Fed could cut. Under surveillance this morning, keeping big tech in check.
What I oftentimes hear from the business community, they want markets to be more open and more fair and more competitive rather than incumbents being able to squash out nascent competitive threats. I mean, our free enterprise system is one where the best ideas are supposed to win. And we've historically seen that it's the disruptors and entrepreneurs that have been a key vector of innovation.
Here's latest. Bloomberg News reporting that the Justice Department is considering a bid to break up Alphabet's Google. This following a landmark court ruling that found the company illegally monopolized the online search market. Any move would be Washington's first push to dismantle a company on those grounds since efforts to break up Microsoft 2 decades ago. Joining us now is Bloomberg's Mike Shepard. Mike, a lot of people are calling this the most consequential case for the internet, going back to the creation of the internet. Can you just lay out the contours of what the government's argument is?
Absolutely, and I think you really touched on the theme here, and that is just the scale and the consequence of this. It would be, as we noted, the first attempt by the government to break up a big company since it went after unsuccessfully Microsoft more than 2 decades ago. Here's what they're going after. They are weighing whether to force Google to divest its Android operating system, its Chrome browser, or its AdWords platform for search text ads. It's not just online search that was found to be a monopoly by Google, but also the search text ad market. And the judge in the case is asking the government to come up with potential remedies that it can present, even as Google is challenging the initial order that the judge issued just a week ago. This scoop from Leah Nyland and Anna Edgerton, our colleagues here on the legal and tech teams, really advances the ball in our knowledge of how serious the government is in pursuing this case. And what we're finding from our reporting is just how serious the government is taking this and the kind of signal it is trying to send to other companies it is pursuing on competition grounds.
Shep, over the weekend, J.D. Vance said on Face the Nation that it was the Donald J. Trump presidency that started this antitrust lawsuit. So in a lot of ways, he says him and Trump look at things in a lot of the same ways. They want good work wages for the American people, but also they want to be able to speak their own mind. And sometimes that means you got to take on those monopolies. Whether or not it's Harris or Trump, is this the direction of travel from here on out in Washington, D.C.?
This is really written in the stars now, that it is a bipartisan view that big industry, and especially big tech, has acquired too much clout, not only for its own good, but for, as we just saw FTC chair lay out, the good of innovators and the small tech in Silicon Valley that J.D. Vance knows well as a former venture capitalist. They see the large tech companies, the incumbents, crowding out the smaller players who could bring something in. And they're seeing companies like Google and Apple, which is facing an antitrust case of its own, brought under the Biden administration in March, that the claim is that these companies like Google, like Apple, are crowding out the innovators, and they're also causing consumers like you and me to have to pay more for our goods and services.
Well, Google is just going to say what they do is basically what cereal companies do, or any consumer brand in the grocery market, which is you pay for better eye level when you're in the grocery store shopping. If that's the case, what does the DOJ do with Google when they take this appeal?
Well, what the DOJ is saying in response to that is that, sure, fair enough, you have a system that, sounds like it works for you, but what about the cereal maker who is perpetually at the bottom of the shelf? They are never going to make it to the top tier because they do not have that kind of exclusive contract and relationship already established. So if the government ultimately does not pursue as drastic a remedy as forcing all these divestitures, it will at the very least go after some of these exclusive contracts that require, for example, if you're a device maker and you want to use the Android operating system on your handset or whatever it may be, you have to also make sure that under the current contracts that Gmail and the Chrome browser are on there and they're bolted on there and they're really hard to remove. You basically can't do that. And what that means is that if you're a competitor and have a different browser, a different email platform, you're already at a disadvantage. In other words, to use your cereal analogy, pushed lower on the shelves. And what the government is saying is that there should be more access and more mobility and less restrictive clauses and contingencies and contracts that crowd out through these means other competitors that might want to get in and ones that might offer a better deal to consumers.
But Mike, unlike cereal, which is, if we can stretch this analogy, which is easier to choose and easier to put on a new brand into your bowl, Google is sticky. People have this whole infrastructure around their emails, around the search that they like. So even if we get rid of these agreements that Google has to pay for access to these various phone platforms, how much of a difference will it actually make?
Well, that's a great point, Danny, because the whole issue and argument made by both Apple and Google is, hey, look, our system works really well, and it works well for consumers. There's a lot of ease in it. Once you're in, for example, with Apple, once you're in the Apple ecosystem, you really kind of find it easier to use in a way as a consumer. But the price of entry is high, and that is one of the things in the Apple case the government has gone after. So what the government is seeking is also some interoperability. What they want is so that you have the functionality and everything else you might like about Google, but they want more entrance into the field and into the platform that Google has created and other brands have created as well.
Mike, just real quick here. I'm looking at shares. They're down about 1.1% in the pre-market trading, but they are up about 18% year to date. I'm talking about Google or Alphabet, the parent company. How seriously are people taking this case in terms of its ability to actually win and affect real change?
I think they're in wait-and-see mode. And this is a good question, Lisa, because ultimately, what will be the impact on the business? When you talk about AdWords, the company's search ad business in the most recent quarter generated $46 billion in sales, and that's out of $67 billion in total sales for Alphabet Inc. And so we're talking about a big chunk of change. Now, moving the platform or forcing them to sell it or make some changes will not drastically reduce that revenue. They are still going to be able to sell those ads. It's more how they do it and what gets attached to it. There is also a wait-and-see aspect because of the appeals. Google is going to fight this in court, and investors are waiting to see whether ultimately there is some sort of settlement here.
Bloomberg's Mike Shepard, thank you so much for being with us. It was really interesting, and I can just imagine the cadre of Google lawyers versus Lina Khan in a courtroom.
Well, Google continues to say that they have competition. It's one click away. Like, to use the grocery store analogy, which they use, one eye movement up away is cereal. One click away, you can go to Bing, is their whole defense.
Click is important. Our fingers are, limited in their resources.
It's easy.
Is it though? Anyway, coming up, a surging stock market, driving returns for Norway's sovereign wealth fund in the first half. Don't miss this. CEO Nikolai Tangen joins us next. This is Bloomberg.
The Vivian Tom clientele.
Yeah, power women, like the dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world.
Why do you position your products for this group of women?
When I started, designing, I always want to do something that is empower women.
When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example.
My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, They are like in the 20s, so it's a more affordable price for them. And then, my powerful women's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
What sell-off? It hasn't really happened considering the fact that we just had the biggest four-day pop in the S&P 500 going back to November. Right now, basically, markets are unchanged. Hard to know how to read things ahead of the CPI print coming in about 2 hours' time. NASDAQ futures also pretty much flat, but the NASDAQ, Danny, has been leading throughout this. Russell 2000 right now outperforming, but has been underperforming as people go back to the ones they know best.
I think it'll be interesting to see how the market reacts to if we get a soft CPI report, because last month we did, it was actually S&P 500 that fell and small caps took off like a rocket. We saw that trend continue for some time. It's an odd playbook that usually doesn't happen if there's a softer CPI. It usually powers the whole market. So is this time going to be the same or different?
Well, this playbook seems to be very simple. The Fed's going to cut rates by 100 basis points and everybody wins, because that is essentially what's being priced into the markets. You've seen almost a 40 basis point decline in two-year yields going back to about July 29th. Right now, we're seeing just an ongoing of that trend, 392.67. I remember that time when it was above 4%. T-bills, what does that mean for them? 10-year yields have not declined nearly as much, 3.83%. The 30-year also 4.1%. But really, this all comes down to, does the Fed have enough ammunition to really, Danny, cut rates proactively before we see that pain?
The language suggests that they don't feel that they are there yet. And I go back to Bostic's comments yesterday. Everything he said, we want to be absolutely sure. I'm willing to wait, but it's coming. I want to see a little bit more data. All of that suggests that they are not there yet. So the CPI could be crucial in importance to changing them. Again, I go back to the RBNZ, who cut rates today and said, we can do it because it is low risk and it is not a difficult decision. Maybe the Fed starts to sound more like that in Jackson Hole.
And if you're looking for members of the Fed who want to lean into the labor market, especially we've been looking at all of this labor data coming out, the prior report that was soft. Thomas Barkin said, there's no hiring, there's no firing. It's basically flat. So then that reiterates this idea that they need more prints. And Stuart Keisers, who's going to be joining us, said it's not that they need better inflation prints, particularly better. He says what they need is more. They've been talking about how they need to see this trend. Will we get that today?
All I can say is Danny's making New Zealand great again. Meanwhile, if you bleed this through the currency market, you do see the euro pretty much at the highest level, the strongest level versus the dollar, going back to the very beginning of this year. Under surveillance this morning, U.S. CPI data due in about 2 hours at 8:30 a.m. Eastern. The median estimate in Bloomberg's survey seeing a modest gain of 0.2% on headline inflation last month, likely cementing expectations for a Fed rate cut in September. Danny, I think one of the most interesting aspects is just how coiled markets are going into that for a soft print.
It's important to think of what happened since last month's CPI print. It was the peak in dollar yen, and we saw the madness after that. You saw two-year yields, you've been talking about this, go from 4.5% to under 4%. We had this mad rally in give back in small caps and equities as a whole. So it's been a real big trend shift in this market. And today, I think, serves as a referendum on that. Will it continue, or is it just more volatile and chop as we try to figure out where we're going from here?
Meanwhile, in the wheel of different stories that just keep spinning around, we also have wondered where the political influence has been, and people have tried to kind of push it aside, but it's very much there. Kamala Harris rolling out details of her economic plan in North Carolina on Friday. A campaign announcement said Harris will speak in the swing state on her plan to, quote, lower costs for middle-class families and take on corporate price gouging. It is a rather difficult needle for her to thread, Anne-Marie, considering the fact that she wants to distinguish herself from President Biden while also basically supporting the plans that he put out there.
She's going to be touting what they would call some of the wins from the Biden administration, the Biden-Harris administration. But at the same time, if you look at the polling, inflation remains top of mind. And if you ask voters, who do you think does better with the economy, especially when it comes to inflation, because we had that FT poll, which they say they trust Kamala Harris with the economy more than former President Trump. When you look under the hood, when you look at inflation, it does seem that voters think that Trump did a better job. So it's going to be a hard needle for her to thread, because she needs to, at the same time, talk about maybe some of the wins and a continuation of Biden. She has to put some distance there.
I also am very much looking forward to talking about policy once again, rather than simply the tit for tat. So my personal opinion,
finally get some.
There you go. I am very much looking forward to that. Meanwhile, earnings keep coming in, both from corporate America, corporates globally, as well as investment firms. Norway's $1.7 trillion sovereign wealth fund returning 8.6% in the first half, with a surging stock market driving the gains. The fund revealing that it trimmed holdings in Meta, Novo Nordisk, and ASML. Apple, Microsoft, and NVIDIA were its three biggest investments at the end of June. Nikolai Tangen, star of the podcast world, also who happens to be the CEO of the biggest sovereign wealth fund in the world, Norway's sovereign wealth fund, joining us now. Nikolai, great to see you. Thank you for being with us. I want to start with the idea of lightening up a little bit of some of the tech holdings, and whether this is basically your view on the idea that leadership in the equity market might normalize a little bit more, away from just the big tech leaders to the broader market in general.
Well, it's difficult to say. As you know, we are an index near fund, and so the large tech companies will automatically be some of the largest positions we have. I think it's interesting now that the 7 biggest companies we have combined is like 12% of the fund. So it's a type of concentration risk that we have never seen before. And of course, that's a bit worrisome.
Nikolai, I just wonder how you think about this moment more broadly. We're waiting for CPI in the US, but in the rest of the developed world, rates have started to come back in. The conversation has changed to fear of recession. For you, is this the start of a paradigm shift for this economy and these markets?
I'm not so sure that that's the case. We think that inflation generally will be pretty slow to come down. We're seeing some inflationary pressures, actually from the climate. We're seeing some food elements within the CPI, such as olive oil, orange juice, all these kind of things. These prices are continuing to rise, and we think that will be part of the effects which keep inflation higher for a bit longer.
Well, as inflation is higher, to your point, Nikolai, the big tech just keeps getting more and more concentrated. I know you've trimmed back on some of your holdings, but do you worry about the unhealthiness of an overall market that keeps contending with central banks doing the same thing, about not a shift? Is it a market that you worry has gotten over-leveraged and you could see more events like a volatility akin to last week?
Well, I think if you talk about leverage, I think the thing that worry us here is the debt levels we are seeing in many countries. The budget deficits, which continue to be there, continue to build. The debt levels are very high. And I think that's really the biggest worry we have. You see what can happen if you get these kind of trust moments, which we saw in the UK, where suddenly people lose faith. And that's probably the biggest risk we are facing today.
What I find fascinating, Nikolai, is when we talk to you, you really emphasize the fact that you're hinged to the index. You own the world, essentially, and you are sort of susceptible to the different trends that come into play. One thing that you've been very vocal about is that you're trying to use your position as the biggest sovereign wealth fund in the world to influence change. And I'm wondering, with respect to concentration, as an example, we're seeing the Department of Justice in the U.S. go after some of the big tech funds to try to increase competition. Do you think that's a good thing? Are you arguing within board seats saying, you should make efforts to try to open up the competitive field?
Well, we as big owners, we are not advocating to split up large tech companies. Of course, we think that things like AI should be regulated, and we really need to have responsible use of AI, but we are not really interfering in the debate about whether these tech companies whether one should go after them or not. I think they generally do. They are fantastic companies. They are well run, and they are important investments for us.
It kind of goes to the heart of this issue that comes up so much, Nikolai, which is how do you balance having a sort of social overview for your fund where you're trying to invest in renewable energies, you're trying to argue for changes at the tops of companies while maximizing returns that might not cohere with some of those trends so perfectly. I'm thinking of, say, fossil fuels or the renewable energy infrastructure that didn't perform as you had hoped.
Well, a couple of things there. First of all, we think you have more influence as an owner as you have compared to if you just sell out your holdings, right? We have continuous dialogues with these companies. During the first half, we had more than 2,000 conversations with our companies. And so being an owner is the best thing you can do in terms of impacting change. The second thing is that we think being a responsible company and delivering good returns is going hand in hand. If you're not a responsible company, you will not have people working for you, you will not have clients, you won't get insurance, you won't get bank loans. So it really goes hand in hand, and you need to think long-term as a responsible company to generate the returns.
Nikolai, how are you thinking about the U.S. election and the impact either Trump 2.0 or Harris administration will have on investors?
Yeah, you know what? You'd be surprised by how little we think about the U.S. election, because we are invested in the U.S. companies, and both parties are, in our mind, pro-business. And so we don't think that's going to have a huge impact on our portfolio.
You think both Trump 2.0 and Kamala Harris are pro-business? You think both Democrats and Republicans are pro-business?
We think generally speaking that the large U.S. companies which we are invested in will continue to do well, whoever wins the election.
We know you're a big holder of Tesla and you voted against Elon Musk's pay package. What do you make of corporate America, some CEOs like Elon Musk, really tying themselves to one camp? Clearly, he's in the Trump camp with his most recent conversation with the former president this week.
Well, I think it's interesting, and I think it's a new phenomena, and of course, it is risky for companies to tie themselves too closely to one camp.
Nikolai, can you just expand on that a little bit? Because obviously when you look at companies, there are different metrics you have to look at. And some of the metrics include governance. Does that kind of fall into the governance camp? Do you need to take a second look at companies that are maybe getting too political?
No, I don't think we need to do that. We would not want to sell out of a company if it's close to one political party or the other one. So I don't think that's necessarily relevant for that decision. But of course, you have to think about risk to people's business.